Until the start of cash equity trading, I'm Francine Lacqua here in London, and here are your top stories. Bailey's warning after the biggest rate hike in 27 years. The Bank of England governor tells the UK to brace for contraction and unrelenting inflation. Jobs in focus while the U.S. labor market may be cooling. Today's payrolls report also expected to show hiring holding up. And with a whimper or with a bang, as earnings season starts to wind down, we'll break down the top trends and, of course, the key takeaways. Now, let's take a look at the futures. We've had a bit of volatility this week. That's probably understatement, if not the year of the month. Stocks in Asia actually climbing. U.S. equity futures also climbing. And you can see Euro stocks are pretty much stable. We're seeing a bit of pressure. I mean, not even pressure. They're kind of really unchanged after the being whipsawed all week. They're looking at technology shares. They're getting that bit of a boost that we saw in Asia. The focus, of course, on corporate stories, and that really depends on what sector you're in and what kind of regional exposure you have. And then oil, the biggest story because of the caps here in the UK, for example, in terms of how much you spend, but also OPEC with that really minimal, almost non-existent production increase, oil snapping a slide, investor sentiment a little bit more steady than it was earlier in the week. All right, some of these equities are now opening. The IBEX in Spain, the FTSE 100 here in the UK, is pretty much flat. As always, I would urge everyone to look at foreign exchange, British pound 121.64 for cable, and the euro 102.35. Now, the main things we need to watch out for is, of course, a U.S. 10-year yield. So let's get to your cross-asset check. Away from commodities, which we're always keeping an eye on, currently Brent 94.63 is, of course, what's happening in the U.S. 10-year yield, 2.6809. Once again, a bit more stability. Now, let's get over to the Bloomberg MLive managing editor Mark Cardmore. We've made it through the week, and you're looking at U.S. jobs.
Yes, Francine, I've only just made it about through this week, but yes, there will be jobs later on. I hope that I will not be paying attention. I would claim that I'm asleep, but I'm actually playing a poker game with some people later on tonight. But anyway, we'll pay attention. Here are three charts just to tee up for that jobs data, because I do think it's very important, given some of the obsession about recession risk recently. And of course, we have CPI next week going to the inflation print. So the first one is about the total number of jobs according to non-farm payrolls. We are very close to the pre-pandemic high. We won't reach it today unless we get a shocking beat. So I don't think, but we're going to get there very close. And I think this is important to emphasize in the context of everyone talking about the recession risks. We have nearly restored all the major 21 million jobs that we lost in the pandemic, and we continue to see very steady growth. Now I want to show you the next chart, which shows the expectations today are 250K. That is lower than the last couple of months. The last month was 372K. We've seen pretty incredible gains, actually close to 400K for the last few months, and over that is the average of the 5-month average. But for the last 3 months, we've seen the number beat forecast. The blue line here is the economist forecast. The white line is where they come in. Now, it's a very volatile series, so I wouldn't want to read too much into that, but it's slightly interesting. In context, this is the first time in the last couple of years that we've actually seen 3 beats in a row. And I think that emphasized the story that, hey, U.S. economists in the U.S. are getting too negative on the economy. The final chart I want to show you is perhaps the most shocking. It's the ratio of job openings to unemployed in the U.S. And we've talked recently about the jolts coming down, about the fact that job openings are falling down. Yes, they are, but they're falling down from an incredible level. And obviously, unemployment rates are near record lows. So you can see, look back at the last 2 decades. Sure, we've come down from the peak, but job openings relative to unemployment rate can fall much, much further, and the job market will still remain red hot. And that is the backdrop going to today's jobs market.
Thank you so much. Our Mark Cudmore there with the very latest. It was interesting, Mark, also to hear the Bank of England say that actually a lot of people have not come back from or going back to work because of long COVID. I want to see Mark Cudmore in a poker game, maybe with the world central banks. I feel like there'd be good parallels, Mark.
I'd enjoy that too, so I hope you can arrange it, Francine.
Live on TV, Mark Cudmore there with the very latest poker and looking at U.S. jobs. Now, the Bank of England says the UK faces a protracted recession after it raised interest rates by 50 basis points to 1.75%, the biggest increase in 27 years. Well, we spoke with the Bank of England Governor, Andrew Bailey.
Well, we've had a very big shock since we last probably talked to them since we last did the last monetary policy report at the beginning of May. That shock predominantly comes from Russia in terms of the impact on gas prices. There's been huge impact. Now, we've highlighted in the monetary policy report the risks as we see them, and I think there are risks both internationally and domestically. The international risk is, yes, it is very unpredictable what can happen. We've seen very big things happen. By the way, many other commodity prices have gone down since we last saw them, so things don't always go one way. I think
it just seems like it's in a spiral. So, given where we are now, could it get much worse? And can fiscal policy help at the margin in trying to temper the downturn?
Well, can I say, I think fiscal policy is for governments. The government will, we condition our view at the moment on what's been announced, what the last budget was. Obviously, there's a leadership election going on. I look forward to working with the new Prime Minister, and I'm sure there will be fiscal policy determined after that, and that's the appropriate way to do it. So we'll take fiscal policy when it's announced, but that's the right way to do that.
How ugly is this recession going to be?
Well, I think the real ugliness, to use your words, is of course that you've got a combination of high inflation and a recession forecast. The recession that we forecast today is by historical standards, it's not one of the deeper ones, we hope and expect. But it comes with high inflation, and that is of course a very, very difficult combination.
Given again, because it's been so difficult to predict, do you think your models are fit for purpose?
I think the approach is very much fit for purpose, and I think this situation emphasises why independent central banks are so important. This is when we're really challenged. This is the toughest challenge we've had in the 25 years of the MPC. This is when we are most, our framework is most put to test. And as I've said, I said it again today, we will get inflation back to target. There's no question about that. So that's my message to people in the street. Now, of course, it's very hard. I mean, it is very hard, particularly for those on low incomes in this country who are much more affected by inflation, which is concentrated, as it is, in energy particularly. But if we don't get it under control, it will get worse, and we will have to raise interest rates by more.
Well, that was the Bank of England Governor, Andrew Bailey, speaking to me yesterday after the press conference. Let's get more with Bloomberg's Lizzie Burden. Lizzie, if you think about it, I mean, we kind of were expecting 50 basis points, but, I mean, the forecasts are just so ugly.
Yeah, that is precisely the word. I'm trying to hide how depressed I feel about this morning, and it's hard. I don't know about you. You were in the room with Andrew Bailey. It's across all the front pages of the UK newspapers today. The fact is, the bank has had to go for this jumbo rate hike, which it says itself is going to lead to a long, if shallow, recession, the likes of which we haven't seen since the 1990s, because it now sees inflation not just in double digits, but above 13%. This is a dilemma the bank has never had to deal with in its independent history. And these forecasts may be bleak, yeah. You would hope that they're bleaker than the reality is going to be, because, of course, the bank can't take account of unconfirmed fiscal policy. But then you've got all these warnings that Liz Truss, the frontrunner to be the next Prime Minister, her tax cuts might be inflationary. And the other thing that came out of this meeting yesterday was the quantitative tightening point. We're going to get £80 billion within the first year. £10 billion of active sales a quarter. You asked yesterday how much that equates to in interest rate rises, basis points of rate rises.
I did not get an answer.
You didn't. And yet they are trying to emphasise that rate rises are the active tool. Frankly, this is difficult for markets to ignore.
Yeah, and yesterday it did feel like actually it wasn't about the markets. It was really trying to tell people, like, look, this is going to be really tough. and it's especially the lower income families that will suffer the most. Lizzie, thank you. Lizzie Burden there with the very latest on the Bank of England. Now, also don't miss our exclusive interview with the chief economist at the Bank of England, Hugh Pill. We'll delve into that a little bit more. And of course, if you have any questions for Hugh, he's coming up at 9:40 a.m. UK time on Bloomberg Surveillance Early Edition. You can send in your questions on IB plus TV Go, or you can also tweet me directly. Now let's get into the key market drivers with Seema Shah, Chief Strategist for Principal Global Investors. Seema, if we start, good morning, first of all, if we start with the Bank of England, I mean, this is also the conundrum. If we're looking at these stagflationary pressures that the rest of the central banks around the world will have to deal with it, is the Bank of England just more honest than others?
Yes. And I think it would be great if other central banks would be so honest. You know, we would rarely see any other central bank explicitly forecast a recession, certainly a recession as long as the Bank of England is saying. But I think, you know, they have to be realistic. You know, the UK economy, just as the US and Europe is really facing a significant dilemma. As you said, there is high inflation. They've got to raise interest rates in order to clamp that down. Unfortunately, that does mean that recession is coming. I think the fiscal policy questions, I think it's good. If anything, that the Bank of England doesn't start to incorporate those in their forecast. It gets very, very messy, and I think that's one thing that we need to wait and see how that pans out.
So, Seema, what does it mean? I mean, the markets were pretty sanguine, actually, about what we heard yesterday. Was this a mistake? Is it because they were expecting 50 basis points and so didn't really pay that much attention to what kind of recession we'll see?
I think that, as you said, so the market was expecting a 50 basis point move, but I also think that the market has been anticipating a UK recession. So this didn't really come as a surprise. I think what the surprise is actually that the Bank of England was quite so explicit. But, you know, we can all see that the rate hikes are happening. We can all see the amount that households are being crimped. And I think perhaps there's a little bit of optimism in the market that the government can come in and introduce these kind of tax cuts, which will maybe start to subdue some of the negative impact from interest rate hikes. I have to say, I worry about that because, you know, as we've just heard, that could certainly be inflationary. And that would only just complicate the Bank of England's decision-making, and certainly it could mean that more rate hikes are necessary.
Seema, what are you expecting from, I mean, in general, though, because fiscal policy can change everything, do we believe the forecast of the Bank of England? Or is there a possibility that they're going for a worst-case scenario and then see what happens in September?
So we are expecting a UK recession, probably not as long as what the Bank of England had been anticipating. We've been thinking about 3 quarters rather than 5. But of course, look, this is all within the realms of all the uncertainty that we're faced with. You know, at the moment, one of the key impacts for the UK and certainly for the European economy is, of course, the Russia-Ukraine crisis and how that impacts natural gas prices. So there is a huge amount of uncertainty. I think they have to go with what is most realistic. It could be better than expected, hopefully, but it certainly could be even worse if you were to see things with the Russia-Ukraine crisis continue to spiral.
Seema, what are you expecting from the US today, the jobs market?
So we are expecting about a 250,000 increase in payrolls today. Now it would of course be a slowdown compared to the previous month, which I think have been averaging about 375,000 per month over the last quarter. But we have to remember that actually in normal times, to pre-COVID times, a good number would have been about 175,000. So this would still be a strong number, and it continues to message that the labour market continues to be very tight and continues to be extremely strong, and therefore the Federal Reserve still has its work cut out for them.
Great. Seema, thank you so much. We have a great chart looking at the U.S. labor market, and we'll get more on that. And, of course, some of the hawkish comments we got from Fed officials. Seema Shah, Chief Strategist for Principal Global Investors, stays with us. In the meantime, we keep an eye on geopolitics. It was quite a week with the Nancy Pelosi visit to Taiwan. Secretary Blinken saying that China provocative actions are significant escalation. China, of course, will say that was an escalation because Nancy Pelosi went to Taiwan. We'll keep a very close eye on this, and we'll bring you the very latest. Coming up, it's dominated the economic news agenda of the year, but how has inflation affected corporate results in the last quarter? We discuss that next. This is Bloomberg.
is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
I would say probably, mild, moderate recession, maybe 18 months-ish. And I think inflation is going to drop rapidly. That's my guess.
Well, Elon Musk there speaking at the Tesla AGM. He is never boring, and we're, of course, expecting a lot more news from, Twitter. There seems to be like a legal fight every day played out on Twitter, and then we understand that actually, I think it's the 18th of October, that they will go head-to-head in front of a judge. Now, let's also look at some of the main stocks that are on the move at the open. We start with Allianz. This is a story that's not going great for Allianz. PIMCO clients pulled another $29 billion, as, of course, some of the rate hikes have been hitting some of the bond fund. So we'll see exactly what happens in the next couple of quarters, but it will be tough as the market positioning means that maybe they go less for some of the bonds to look at some of the more active management. The London Stock Exchange Group, a big one that we saw with that hike, 1.74% higher actually for the share price, starting the £750 million buyback after a pretty strong first half. And then you can see Deutsche Post, one of the biggest gainers in today's trading session, gaining 5%. Now, another week of corporate earnings has come to a close, with inflation continuing to dominate the conversation. Let's get a view on the outlook for corporate earnings with our guest, Seema Shah, Chief Strategist for Principal Global Investors. And Seema, first of all, thank you so much for staying with us. But if you look at the increase in interest rates, I mean, a lot of the banks should benefit, but they haven't that much. So where do you find value?
Look, it's a really tough market at the moment to find good opportunities. I think they do exist. I think we said we have to look outside of Europe. We typically are looking towards the US or even emerging markets to find the kind of any kind of strong opportunities. We are looking increasingly at mid-caps, and the reason for that is if you look at the US mid-cap space, they have less exposure to the international markets, to the European market specifically, whereas the large cap companies typically do have a lot of revenue exposure. So we prefer to be more US focused at the moment, which means more mid-cap space, whereas the small caps, of course, as we know, will be typically more price sensitive and find it more difficult to pass on some of the cost increases that they're facing.
Seema, when you look at U.S. stocks, anything in particular? Again, is it exposure, for example, to China that you're trying to stay away from, or is it just companies that had pretty solid earnings going forward?
Yeah, so it's really about the quality. It's a really cloudy term, but typically what we're looking for is companies with really strong balance sheets, the ones that can really deal with what we think is going to be quite a challenging economic environment as we go into 2023. The ones that have got the pricing power, but also, as I said, less exposure to outside of the US, so really more domestically focused.
What do you do? Are there any havens out there, Seema, that you can still buy that don't look too expensive to hedge against inflation?
Yeah, so look, outside of equities and certainly outside of fixed income, we do think that this is a good environment still for real assets. You know, we know that, as I said, equities, fixed income is still very challenged. So if you're looking for some diversification, that's where real assets can come in. And on top of that, of course, they provide that inflation mitigation, which is still very much top of mind. And specifically within real assets, our favorites are infrastructure, listed infrastructure. They have typically outperformed both equities and fixed income when times get really tough. So if you have a high inflation, low growth environment, just like the one that we're going into, this is when listed infrastructure typically outperforms.
Yeah. Seema, I know the energy crisis in Europe is escalating, but at what point do markets start pricing in a gas embargo, full gas embargo from Russia?
No, I don't think it's yet. Now, I think, look, when we look at earnings and we look at valuations, Europe is very cheap. It's cheap relative to the US, and it's also pretty cheap relative to history. So we do think, on that note, that actually a lot of the earnings expectations are already pricing in some difficulty ahead for the European economy. But of course, they don't go so far as to price in a full embargo, because that is a tail risk. Unfortunately, what we are seeing, though, is that tail risk is steadily becoming, moving closer towards that baseline scenario. We're not going to say that's the baseline scenario just yet, but it does mean that as that risk continues to increase, it becomes very difficult for investors to focus on Europe when you have got other opportunities outside. So, you know, I think there is some weakness priced in, but it probably doesn't quite go far enough.
Seema, thank you so much. Seema Shah, their Chief Strategist for Principal Global Investors, joining us. Now, coming up, bank bonuses are set to come down. We look at how Wall Street and the city are responding. That's coming up next, and this is Bloomberg.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Welcome back to the Open, everyone. 22 minutes into the European trading day, and you can see it's a bit of a mixed bag, but nothing huge. Really, a bit of stability. I'd probably say that's how I would describe these global stocks. They're still overall near a 2-month high. We did have concerning news with geopolitics, U.S.-China getting worse in terms of those agreements, and at the same time, that really horrible warning from the Bank of England about a recession looming, a 1-year-long recession. And then today we look at U.S. jobs. But pretty much you can see the FTSE down 0.2%, and that's your biggest loser. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Allianz has reported higher profits in the latest 3 months, driven by its property casualty insurance business. But its giant bond unit, PIMCO, saw outside clients pull money for a second straight quarter.
I wouldn't say that we are in a situation where we have a capitulation, but I think we are entering anyway a situation of more stability after what has been a strong shock in the interest rates development.
Facebook parent Meta has sold $10 billion of debt in its first ever corporate bond deal. Bloomberg has learned the social media giant sold its bonds across 4 parts, with the longest part of the offering a 40-year security. Meta was one of the few S&P 500 companies without debt until now and is facing slow cash flows. That's your Bloomberg Business Flash. Francine.
Laura, thank you so much. Laura Wright in London. Now, the world's biggest banks stunned observers last year as they dished out eye-popping bonuses to everyone from rainmakers to junior analysts. But now some lenders are saying a tougher economic climate means that bank staff should brace for much smaller bonuses in the months ahead. Now, for more on all of this, let's talk to Bloomberg's Charlie Wells, our expert in all things bonuses and banking and private wealth. And he joins us now. I mean, the concern, well, not the concern, but if you're also in a bank that's doing really badly, you need to pay your staff to retain them. So what kind of big bonuses should we expect or not expect?
Yeah, Francine, so I'll cut straight to the chase here. If you are on the sort of team that is underwriting debt or equity, it's not looking good for you. So according to a new report by compensation consultants Johnson Associates, those sorts of teams should be looking for bonus declines of about 45%. Also not great for M&A, down about 25%, but good news on the trading side. So you could see your bonus potentially up about 10%. If you're on the equities trading side, fixed income up maybe 20%.
Okay, so why the belt tightening?
Yeah, so look, we just have seen that this is not the sort of environment where deals are getting done. So if tumbleweeds are literally blowing through your team at a bank, you really shouldn't expect that bonus to be looking very good. This is just not that sort of environment. But of course, in a volatile environment, that trading side has been doing well, and these bonuses, of course, are based on performance.
But then we always hear like there's this war on talent. So if you're a top performer, are you okay? Do you need to be overpaid to be retained?
That's why there's been so much whiplash and why it's a little bit confusing, right? We heard Credit Suisse paying, millions to retain staff to try to keep those defections from rainmakers from leaving. We've heard of junior pay here in London at some banks go up, but overall it is looking like as these conversations about bonuses start heating up in the boardrooms, it's not looking good for many staff.
So how do you describe the next 6 to 7 months? Because you have the cost of living, which is not really impacting, of course, the higher, wagers,
right,
families compared to the smaller ones. But then do you just go and work for a tech company if you want to earn more money?
I mean, that's the concern, because if you thought about that maybe a few months ago, that would have looked like an attractive option. But what we've seen at these tech companies is actually layoffs. We've seen hiring freezes, and so that's less attractive than it may have been just a few months ago for a banker.
Charlie, thank you so much. As always, Charlie Wells there, looking at some of the bonuses in tech, but also in banks. Coming up with earnings season winding down, we look at how companies are facing up to the economic headwinds. That's coming up ahead. This is Bloomberg. Global stocks nearing a 2-month high, helped by gains in technology shares. Oil also snapping a slide as investor sentiment steady after another pretty turbulent week.
companies need to think about how they normalize Blackness and they normalize the Black aesthetic and what it really means to be inclusive. And that means to recognize and appreciate and respect and celebrate all aspects of culture and different cultures. And so it's critically important that we recognize that this is an issue, just as my sisters have said, and make sure that we recognize how that issue shows up in the workplace and how we can be advocates and allies in action to ensure that no person, no Black person in this country feels marginalized or disrespected or diminished in any way because of their hair or their race.
So the challenge is not everyone understands that race-based hair discrimination is a reality. And so we find ourselves constantly educating people, including lawmakers, to ensure that they understand that hair discrimination is racial discrimination. And so we are working collaboratively, the four of us championing this work together, along with the Crown Coalition, to ensure that race-based hair discrimination is outlawed nationwide.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Bailey's warning after the biggest rate hike in 27 years. The Bank of England governor tells the UK to brace for contraction amid unrelenting inflation. Jobs in focus. While the labor market may be cooling, today's payrolls report is expected to show hiring holding up. Plus, with a whimper or with a bang, as the earnings season winds down, we'll break down the top trends and key takeaways. Now, quickly, equities. This is where it's all playing out. But if you look at equities, finally, after pretty volatile, and that is probably the understatement of the month, that we're seeing a bit of stability. European stock 600 pretty much flat, just a bit more pressure on the FTSE 100. This is probably also a sterling story because of what the Bank of England could do. Overall, U.S. equity futures are also holding on to gains, and this is led by technology. So let's get into some of the biggest sector moves that we're seeing. I think technology holding up strong. If you look at also travel and leisure, we have basic resources. I know oil stabilized a little bit after the slide that we saw earlier on in the week, as investor sentiment is pretty steady. Basic resources, one of the biggest gainers, 0.6% higher. Also have travel and leisure and retail. And then on the way down, we have media and insurance. Now, don't miss our exclusive interview with the Bank of England's chief economist, Hugh Pill. That will give us a good indication maybe on some of the questions that the markets had yesterday in terms of QT, but also we want to try and understand really what has happened to the UK economy, that they're now predicting a recession. It's something that they weren't just a couple of months ago, and how bad could inflation be? Hugh Pill, it's an exclusive interview right on this show. You can send your questions on IB Plus TV Go. Now, another week of earnings comes to a close. Inflation, the topic dominating the conversation, so let's get an idea of what some leaders think about rising prices.
Inflation gets worse.
We have the steepest challenge in cost inflation.
Inflation is going to stay.
We certainly see peak inflation coming sometime in the second half.
We have some double-digit inflationary costs.
Simple reality is we're seeing inflation everywhere.
Maybe the economy will stagnate, but it might also fall into a recession.
We do see a softening of economic conditions in the second half of the year and potentially a recession, at least at this point, a modest recession.
We are, of course, watching central banks' reaction to that inflation.
It's a mix of inflation and the labor market circumstances. If inflation continues to be here, of course, it will be reflected also in pay.
Turbulent times, as you've been saying all morning, absolutely.
Well, for more on what we've learned this season from companies on the outlook for the economy, we're joined by our Bloomberg Intelligence senior European equity strategist, Tim Craighead. Tim, good morning. So how worried are companies about inflation and therefore in turn recession?
Well, indeed, Francine, I think those quotes really put it out there in terms of the color commentary that CEOs, CFOs are bringing forward. But I have to say, it's been a particularly surprising earnings season to us in that we thought that all of this was going to sort of hit the fan this earnings season. We would see earnings crack. And in fact, we haven't. European companies have been surprisingly able to pass along higher costs to clients. A lot of this has been energy related, and maybe that's part of the acceptance. It's been much less evident in the U.S., where there's been more signs of disappointment and stress on passing along those costs. And within that context, you know, it's particularly interesting that we're going to end the earnings season with something like 20% earnings growth relative to 16% expected going in. So it's been a surprising season.
So, Tim, this earnings season was different for banks because rates, of course, are going up. How did that impact earnings?
Yeah, I think banks are in the midst of a sweet spot. Capital positions continue to be strong, and we're seeing with those core consumer commercial banks the positive impact of rising short-term interest rates, with net interest margins and net interest income driving better than expected results that are feeding, at this point, better dividends and buybacks. So think about a Lloyd's, think about a D&B, think about a UniCredit. We're seeing better earnings. It's a low duration group that we think is well positioned if we have rising interest rates.
So, Tim, we saw a blowout quarter, though, for oil majors. I mean, did they just go from strength to strength?
Well, there, Francine, I think we're in an interesting quandary. On the one hand, they're producing huge earnings. On the other hand, there's a big question, well, what do they do with all this money? And the good news is, from the standpoint of investing in this group, they're distributing the capital. You look at Shell, BP, and others, the total distribution yield, if you take buybacks and dividends, it can be as high as 14 or 15%. It's huge. They're not putting the money back into the ground to generate more oil and gas discoveries, because they're in the midst of energy transition investing. And from that perspective, we think we've got elevated prices that frankly could produce better than expected earnings next year, where in general consensus looks to see a big slide.
Thank you so much, as always, for your thoughtful analysis. Tim Craighead there, our senior European equity strategist with Bloomberg Intelligence, and you can read more of Tim's insights by typing BI and hitting go on the Bloomberg terminal. Now, joining us to talk about everything that we've seen, not this week, although this week feels like it was like 3 months crammed into 5 days, but is Mateus Debo. He's a senior strategist of the investment strategy group at Goldman Sachs. Mateus, we've made it to Friday. I'm like TGIF because it's been quite a week. I mean, if you look at some of the forces, of course, it's inflation, but certainly the BOE kind of crystallized this idea that we're now looking at stagflation. How do we get out of this?
And good morning, Francine. Thanks for having me. The debate, the struggle between inflation and recession is certainly having a large impact on markets. So on the inflation side of things, we do believe that at least in the U.S., we'll start to see some better news going forward. If you look at what is happening with gasoline prices down substantially from the recent highs, supply chain disruptions improving, retailers offering discounts, the PMI and ISM price indices all down, this all seems to suggest that we will probably see the peak in inflation. We've already seen it, or we'll see it very soon. Now, in the euro area and the UK, much will depend on what happens with energy prices going forward, but we don't think we have seen the peak just yet. Now,
because we don't know. So is your base, should we start looking at actually a gas embargo as base case? I don't know how much of that is priced into gas prices.
So it's very difficult to know what the market is pricing in, as always. Our base case is that we will continue to see some flows to Europe, but I mean, well below what we were seeing previously. So that will have an impact on the region's economy, and that will result in some form of rationing in the fourth quarter of this year.
So recession is a given?
It's not a given, but the odds are clearly rising. If you look at across the major developed economies, the odds of recession over the next 12 months are quite elevated. And the drivers of that increase in that recession probability vary from region to region. So in the US, you have the substantial tightening in financial conditions that we have seen. In the euro area, the concerns around Russian gas flows. And in the UK, the large decline in households' purchasing power. So as a result, we do think that a recession is not inevitable, but the odds are rising.
So is there anything that governments at this point can do? I mean, I don't know, you know, we need to talk a bit about the UK with the leadership contest and what they're expecting to do. But overall, the impact on unemployment could be what? I mean, it's just looking like it's going to be a very difficult 8 months ahead.
True, although the labor market continues to show surprising strength, right? In the UK, if you look at wage growth, is running well above its historical average, and it's very broad-based. So we actually think there is some scope for the labor market to continue to do relatively okay, but much will depend, again, on what happens going forward. We don't think the Bank of England will be as aggressive as the market is pricing in terms of its rate hikes, and we think there is scope for some fiscal easing with the next leader of the Conservative Party.
But then that's inflationary. It's like
Yes.
a catch-22, Mateus. Like what?
It really is.
So what happens?
So central banks have their work cut out for them. So this means that probably interest rates will have to remain elevated for quite a while longer, and that inflation will stay high for the foreseeable future.
Mateus, talk to me a little bit about your conviction calls.
So in the current environment, it's very difficult to have a lot of conviction on anything, but from a tactical perspective, we continue to like the positions that we currently recommend to our clients because those are assets that are very dislocated relative to where we believe their fundamentally justified values are. So think of sectors like U.S. energy companies or Eurozone banks that we were just talking about. But from a more structural perspective, our highest conviction view remains that our clients should have in their portfolios an overweight to U.S. assets funded out of an underweight to emerging market assets. And that is really because all the structural factors that have supported the U.S.'s outperformance over the last several years remain very much in place and have actually become stronger over the last several years, while the headwinds facing emerging markets are only getting worse.
But you have to remain invested.
You have to remain invested.
Why not buy real estate?
So that is certainly an alternative, but if you take a longer-term view, the asset class that has best hedged against inflation over the long run is really public equities and large cap equities. And that is because you want to stay with companies that are able to pass on those higher prices to their consumers. So our recommendation remains that clients should stay invested in equities at this time.
Yeah, it's just there's so many questions about, QT, like we've never really been at this juncture in time. Are we really making history just by looking at how central banks reduce their balance sheet?
So it's a big unknown. We don't know exactly what is going to happen. We only have one data point, so it's very difficult to draw conclusions from there. But certainly we are no longer seeing all the boost from QE that we saw over the last several years. But we take some comfort for instance, from the fact that U.S. 10-year Treasury yields in this cycle seem to have peaked at around 3.5%, which is below the average of the low and stable inflation regime that we've had in the U.S. since April of 1996. So that gives us some comfort that perhaps interest rates can remain relatively low, which should provide some support to equity valuations.
Mateus, is there, and I mean, I kind of have my head with the Bank of England because it was, so recent, but also Germany. Like, what's the forecasting that's most broken in terms of modeling?
So it's perhaps not too surprising that Germany is struggling right now, given its large and energy-intensive manufacturing sector. So everything that we are seeing, the PMIs seem to suggest that the manufacturing sector is already contracting, and Germany enjoyed less of a boost to services from the reopening of Europe's tourism sector. So it will be a challenging few months for Germany, there is no doubt, but we actually think that Southern Europe can actually hold up relatively okay. So when we look at the euro area as a whole, we're forecasting Q3 GDP growth of roughly 0, but then negative in Q4 given some form of gas rationing.
Mateus, thank you so much for joining us. Mateus Debo, they're Senior Strategist of the Investment Strategy Group at Goldman Sachs. Now, coming up, WPP boosts its full-year comparable sales forecast. We speak with the Chief Executive Officer of the advertising giant, Mark Reed. That's coming up next, and this is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns. compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
When big tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions.
Welcome back to the Open, everyone. We're 44 minutes into the European trading day. Stability for the moment after a pretty volatile week. The FTSE, a bit of pressure because of what maybe pound is doing, and the FTSE 100, 7,437. Now, let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. Japan says China likely fired missiles over Taiwan during yesterday's military drills. If confirmed, it would be a major escalation as China have never before flown missiles over the island itself. Tokyo estimated that 5 ballistic missiles landed in Japan's exclusive economic zone, and 4 of them probably flew over the island. Beijing is conducting military exercises in response to US House Speaker Nancy Pelosi's visit to Taiwan. UK leadership frontrunner Liz Truss has doubled down on her economic programme and said that a recession is not inevitable, just hours after the Bank of England forecast a deepening economic crisis with a recession that could last for more than a year. Her rival, former Chancellor Rishi Sunak, said Truss's plans for immediate tax cuts would put fuel on the fire of this inflation spiral.
Under the current proposals, our corporation tax would go up to the same level as France and 10 points ahead of Ireland. And I really worry about our capacity to attract that investment into our economy if we do that. You simply can't tax your way to growth. And I'm afraid the very high taxes we have at the moment, a 70-year high, are likely to lead to a recession. Okay. And that's what the Bank of England is predicting. Okay.
That debate was on Sky News. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Laura, thanks so much. Laura Wright in London. Now, the world's largest advertising agency, WPP, has raised its guidance for the year in a sign of resilient demand for services, even amid an economic downturn. Well, joining us now is WPP's Chief Executive Officer, Mark Reed. Mark, what a great pleasure, actually, to speak to you. Shame it's not in person, but hopefully next time we'll catch up, live. Mark, when you look at inflationary pressures, what are the industries that are cutting down on advertising the most?
Well, look, I mean, the amazing thing is so far, I think we've seen pretty resilient demand, from our clients around the world. Our net sales are up 9%. Overall in the first half, a little bit softer in the second quarter than perhaps the first quarter, but I think we had a pretty good result. So far, we're not seeing cuts from our clients in advertising spend. We are expecting probably slightly slower growth in the second half of the year than we have done in the first, and it's probably going to be much more challenging conditions ahead in 2023.
Yeah, but going forward, do you think, Mark, that a lot of the clients will adapt their spending on marketing strategy, given the threat of recession, given, what we even heard about the Bank of England yesterday?
Look, I think, a few points to make. First, in the UK, there's no doubt there's more challenging economic conditions. The UK is 13% of WPP's business. To put that in context, we have a fantastic business in India, in Brazil, the Middle East, across Asia, and those are impacted by a different set of economic situations. We've seen good demand in the first half of the year. Travel and leisure up 23%, technology up 12%. Some of those sectors will continue to spend. But, we're not naive. no sector is immune to, to economic conditions, and the advertising industry is no different. But what I would say is I think that clients have learned during the pandemic that consistency is what's most important. And those companies that continue to invest, across the pandemic have come out of the business in a much stronger position. And I think that we'll see, fast-sighted companies do the same thing this time.
But is it more targeted advertising? Is it more on social media? Like, how will it change in the next 12 months?
Yeah, look, I think we're seeing a lot of growth in retail media. Clients wanting to drive faster results. We're seeing some companies, though, that want to build brands take advantage of, reduce prices for television commercials. Things get tougher, and that will have a beneficial impact as well. We are seeing a lot of growth in TikTok, probably the fastest growing media platform in the world. And you see the impact of some of that growth from TikTok on the other platforms that are finding life maybe a little bit more difficult. But actually, traditional media, like traditional television, has remained, pretty resilient so far. And as I say, I think we are expecting a slightly softer second half of the year than first half of the year. But clients will continue to invest and innovate, particularly around the areas of e-commerce, digital media, digital transformation.
Are you planning on expanding? Could you actually find bargains out there? Is there anything that you want to buy, given some of the concerns out there?
Well, one of the good things is we are in a pretty strong position financially. We just acquired an e-commerce business in Brazil, a Salesforce marketing technology company in Australia. We acquired a business called Village Marketing, an influencer marketing company in the United States. So these new areas that are growing much faster actually are very interesting to our clients. And I think that's where we invest. I mean, a recession is both a challenge and it's also an opportunity. And we have to continue to invest and innovate in our offer to bring our clients, the latest advances, the latest technologies. Yeah. I think this area of influencer marketing is really, really critical. We're seeing a number of brands and companies, really build strong businesses on the back of very little media.
So are you telling me you're on the hunt for a bargain, or you're on the hunt for something in that space because it brings money longer term?
I wouldn't say we're on the hunt. There are no bargains in this world. I think we've learned that. But I think that we need to, success, I think, comes from consistency. I think continuing to invest, continuing to talk to interesting businesses and work out how they can help our clients and differentiate and strengthen our offer. That's really what we're focused on at the moment, yeah.
Regionally, is there an opportunity in emerging markets more than, for example, Europe because of the exposure on inflation and gas, or how do you see it, that breakup?
That's interesting. Inflation across Asia is much lower, like 3 or 4%, and about 20% of our businesses in Asia. Our business in India grew 48% in the second quarter of the year, up from 24% in the first quarter of the year. So I think that, these faster growing markets in emerging economies, there's no doubt with the change in the oil price, I would expect a pretty strong performance in the Middle East. Markets in Central Europe are clearly more challenged by the situation in Ukraine. So it is a divergent picture. But you talk about recession. The US has gone through 2 quarters of recession, yet ad spend in the US and our business is up 8 or 9%. So it's a strange economy that we live in. But I think financial markets look forward, and we have to do the same thing.
Mark, we had a survey by the World Federation of Advertisers, but also Media Sense found that the industry is facing, I think, what they call worst ever crisis of talent. Are you struggling to attract the right talent, to find the right talent out there?
It doesn't seem that way. We hired 6,000 people in the first half of the year. So clearly we're not having a challenge hiring good people. Look, I think our industry is an attractive industry for people, because we're a creative business. We deal with technology. We work with many of the world's largest and most successful companies. So I think that, but there are challenging times for people. All our people are facing cost of living challenges. We're helping them out. A lot of people continue to work remotely part of the time. We're doing what we can to help people through salary inflation. But I think that we did see supply, shortages in the labour markets earlier in the year. That's eased a little bit, particularly in technology areas, as we've gone through the year.
Yeah. How's it changed? Do you have to pay people more to retain them because of the cost of living and because we talk about inflation, because otherwise you lose them to tech companies like Google and Meta?
Yeah, I mean, I think a little bit less pressure from the technology companies, probably maybe unsurprisingly over the last few quarters. And I think some of that's ease. You know, some of the froth that's come out of the market, I think, is what you see in the tech company results. It's also what we see in technology hiring. We've been able to hire pretty strongly in the technology market in the United States as the year has gone on. We do rely quite a lot on freelancers, and we've seen freelance costs go up more than average salary costs, which I think reflects some of that labour market tightness. And look, you see that in industry after industry, from airlines to airports, you know, the problems of supply chain. I think one good thing we did was we did manage our workforce pretty carefully during the pandemic. We probably cut slightly less than perhaps we could have done, and that's put us in a better position, I think, as we've come back more strongly. So I'm pleased at the way we managed that overall.
Mark, overall, what's your take on the UK? I know there's huge currency swings. I mean, you're such a big global company, and you have so many, you know, businesses around the world. The currency swings are a nightmare. But the UK specifically?
Look, I think, you know, it's clear from what the Bank of England governor said yesterday, you know, there's going to be tough times ahead for a few quarters, particularly, I think, for people from a cost of living perspective. I think what's important to our clients, though, is to show how they can be on the side of the consumers, doing a lot of work with clients, helping them communicate the steps and actions they're taking. So you see the work, you know, that Tesco's doing to show how families can manage their shopping budgets more efficiently, how kids can eat more cheaply in their cafes and restaurants. And I think, you know, a lot of that is really important. You know, we've got to help consumers and our people navigate through the next few quarters. And, you know, advertising and marketing can play, you know, an important role in doing that, I believe.
Mark, indulge me. What's the industry in the UK that's doing the worst? I mean, what kind of advertising would you do for, you know, for a Heathrow, like the travel disruptions? Who would you choose to do an advertising campaign for? Well,
given they're trying to limit the number of passengers going through, probably not the best time to advertise right now. So I think that, look, I mean, companies need to focus on the product. When you've got a good product, that's the time to advertise, probably not when you've got challenges. So I'm not sure that would be the advice I give them right now.
Okay, that's interesting. Mark, thank you so much. As always, the WPP Chief Executive Officer there, Mark Reed. Now, let's take a look at some of the other events that we're following today. The Russian President Vladimir Putin will meet his Turkish counterpart, President Erdogan, for talks in Sochi today, including on a deal reached to unblock exports of grain from Ukraine. Now, 12 p.m. UK time, the Bank of England's chief economist, Hugh Pill, is also due to speak at the Monetary Policy Report National Agency briefing. But before that, he'll be right here on Bloomberg for an exclusive interview, so don't miss that. Then it's Richmond Fed President Thomas Barkin due to speak at an event in Massachusetts. Earlier this week, he said a recession could happen in the process of taming inflation. And finally, the U.S. jobs report expected to show a gain of 250,000 jobs in July and an unchanged unemployment rate of 3.6%. Now, as I was saying, don't miss our exclusive interview with the Bank of England's chief economist. He's Hugh Pill. That's in the next hour. You can also send in your questions on IB Plus TV Go. If you look at equities, they're stable. U.S. equities ticking higher, again, helped by technology shares. Investors bracing for the monthly U.S. jobs report that's likely to enliven the recession debate. Investors in general flocking back to defensive shares, especially in these tech stocks, as falling bond yields are bolstering the appeal of long-duration assets. If you look at the 10-year yield, I think we have that for you. The 10-year yield pretty much steady, and U.S. futures you can see on the upside. That's it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Inflation back to target. There's no question about that.
We are entering anyway a situation of more stability after what has been a strong shock in the interest rates.
The trend is down, which suggests that we are past peak inflation.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Bailey's warning after the biggest rate hike in 27 years. The Bank of England governor tells the UK to brace for contraction amid unrelenting inflation. Jobs in focus. While the U.S. labor market may be cooling, today's payrolls report is expected to show hiring holding up. Plus, with a whimper or with a bang, as earnings season winds down, we'll break down the top trends and key takeaways. Well, we'll have, of course, more on the Bank of England's rate decision. I'm really excited about this interview. It's an exclusive interview with the central bank's chief economist, Hugh Pill. It's about 9:45 a.m. London time. Now, terminal users can just go into IB plus TV Go. You can send questions you'd like answered from Hugh Pill. It is pretty punchy if you think about it. Forecasting a 5-quarter recession. This is what we heard from the Bank of England, whilst at the same time putting up rates 50 basis points. So he'll help us understand exactly the thinking and maybe some of the pitfalls, what it means for the markets, and also QT. Now, let's check on the markets overall after the week that was, and I keep on forgetting that it was only 3 days ago that Nancy Pelosi was in Taiwan. It feels like we've had so much news over the last weekdays that it's kind of a little bit of a blur. So TGIF is what a lot of people are saying in the markets. We do have the U.S. report on jobs today. That could, again, give us an indication of what the Fed does, but we're seeing finally a bit of stability on the markets. S&P futures up a touch, European stocks also, and then the pound is a big one that we're watching out for. I did ask the Bank of England governor yesterday whether a weak pound is tricky going forward. He says, look, we're not seeing a sterling crisis at all, 121.50. Now, the only bit of pressure that we're seeing, if you look at the European map, so we look at the difference, for example, between the DAX, the CAC 40, but also the FTSE, is that the FTSE is one of the indices that, just like the CAC 40, is pretty much unchanged. I think it was down 0.2% a little bit earlier on. Again, not huge, but this is probably a sterling story, and this is probably also an energy story, with the biggest sectors down. Energy very weighted forward, for example, for BP, one of the biggest movers in today's trading session. Now, U.S. jobs growth expected to have slowed in July, according to economists surveyed by Bloomberg. That's as labor demand cools amid tighter monetary policy. Now, back in Europe, it's been a busy earnings season where a recession loomed large on the minds of the continent's business leaders.
Inflation.
Inflation gets worse.
We have the steepest challenge in cost inflation.
Inflation is going to stay.
We certainly see peak inflation coming sometime in the second half.
We have some double-digit inflationary costs.
Simple reality is we're seeing inflation everywhere.
Maybe the economy will stagnate, but it might also fall into a recession.
We do see a softening of economic conditions in the second half of the year and potentially a recession, at least at this point, a modest recession.
We are, of course, watching central banks' reaction to that inflation.
It's a mix of inflation and the labor market circumstances. If inflation continues to be here, of course, it will be reflected also in pay.
Turbulent times, as you've been saying all morning, absolutely.
Now, to talk about the markets, we're joined by Anita Tana, head of EMEA equity sales at Barclays. Anita, thank you for joining us. Inflation, I mean, if you look at the Bank of England forecast, if you're looking at some of the main concerns, I mean, it's been a pretty unsettling week overall.
It absolutely has. As you quite rightly highlight, Bailey was very negative in terms of the outlook for the UK in particular, talking about record high inflation, so 13% in Q4, and obviously that plays into the rates and inflation narrative that has been governing markets all year.
But so what are we expecting from the Bank of England exactly? I mean, I know the market barely moved because they were expecting this 50 basis point increase. But if you think about it, I mean, they're hiking 50 basis points, which they probably have no choice, into 5 quarters of recession. And we have no idea what the fiscal plan looks like, depending on who becomes prime minister.
Absolutely. So they are, like many central banks, stuck between a rock and a hard place. Of course, if they front load on the hikes to get in front of inflation, then the recessionary fears come up. And if they do the opposite, then the inflation fears come up and they're perceived to be behind the curve. So it is a very tricky tightrope for, of course, the Bank of England, but of course for all central banks globally.
Yeah, and they're being praised actually by a couple of economists, including Mohamed El-Arian, saying, well, at least they're honest. Should the Fed do the same, or could it spell mayhem on the markets? So we're looking at, for example, that jobs report later.
Of course. So as you say, the jobs report is quite key, as is all the data points, because the Fed have said that they're data dependent going forwards. Now, I think the key to bring out here is that bad news is good news for markets at the moment, in that the rally that we've seen in the last 6 weeks has really been around the idea that the Fed could be pivoting from the aggressive rates and inflation narrative that we've seen governing markets for a lot of this year to a softer stance. And I think that's what's driven markets in the last 6 weeks in particular, and that's why these data points coming up are so crucial. Yeah. If, of course, they're weaker than expected, it could drive markets that much higher, and the same is true of the opposite.
So what does it mean for Europe? That we're kind of like at the confluence of all this bad news.
Yeah, you're absolutely right. So when we think about Europe in the global context, we, Barclays, are that much more negative on Europe. And part of the reason for that is the proximity to the gas situation. That means that the consumer is in a tougher position. That means corporates are in a tougher position. And it's why we're that much more negative with regards to recessionary fears for Europe versus the rest of the world. Because when we think about recession away from the technical recession that we've seen in the US, for example, when we think about it in terms of a breakdown in the consumer, or very, very tough unemployment trends, that really plays into Europe worse than it does the rest of the world.
So what does it mean for equities? Because you see, so I was surprised. We had this amazing story, which was one of our most read, that's saying, you know, I always thought Germany would pay the brunt because of the energy price, because of the proximity to Russia. But they were saying, you know, France could be one of the worst off because of also some of the nuclear reactors that are not working. Do you go regionally or country by country? Or because the exposure is so much more global, it's more on a group basis?
It's sort of broad-based, isn't it? I think the point that you're bringing out is it could be Germany, it could be France, it could be broader-based within Europe, because everything has a play-through. So it's very difficult to pick out which one in particular, but I think that it's true to say that because of Europe's proximity to the situation, and because it's very, very difficult to diversify sources going into the winter, but also structurally and over the medium term, there is no easy solution.
I think we have a chart. I think our producer just said that we need to talk a little bit about the world food prices. Are we underestimating the impact that this could have on Europe at this point, Anita?
So Actually, what we've seen in the last few weeks or so is some relief around commodity prices and input costs in general, and that has been part of the driver towards the upside for markets in the last 6 weeks or so. It's why short-term things are playing out very, very differently than what investors thought. So there's the short-term at the moment, the relief around the Fed policy pivot, also some of the disinflation trends that you're seeing ever so slightly coming through on that chart. And then there's the medium-term outlook, which is very much more geared to the aggressive rates and inflation narrative. We, Barclays, believe that people are a little bit too bullish on the idea that the Fed will, of course, pivot their policy away from what we've seen much of this year.
So that means bargain hunting, maybe. Where do you find do you have a conviction trade?
So the way we're viewing things at the moment is very much barbelled. So we're being very, very cognizant of the fact that in the short term, there's relief in markets. And so we do have some bullish cyclical exposures that we're recommending. But then we're also saying to have defensive exposures in mind as well, because the medium-term outlook is that much more tricky. So at this juncture, we completely appreciate that things are less clear. In the medium term, we're that much more negative and defensively positioned.
Anita, I mean, our question of the week, and I know you cover more equities, but in general, where's the biggest risk in the credit market right now? Is it something that that we need to get right, or actually the rest of the strategies could go wrong?
So the credit market is a really, really interesting point, and our credit strategists are actually quite negative on markets overall. They are recommending to be defensively positioned, and they're quite concerned about cyclical exposures and the broader read-through from the economic trends that we're seeing.
Anita, thank you so much, as always, for joining us. Anita Tanner, their head of EMEA equity sales at Barclays. Now, coming up, after unleashing the biggest rate hike in 27 years, the Bank of England governor warns the UK to brace for an economic contraction amid unrelenting inflation. That story's up next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England says the UK faces a protracted recession after it raised interest rates by 50 basis points to 1.75%, the biggest increase in 27 years. Here's the Bank of England Governor Andrew Bailey.
we will get inflation back to target. There's no question about that. So that's my message to people in the street. Now, of course, it's very hard. I mean, it is very hard, particularly for those on low incomes in this country who are much more affected by inflation, which is concentrated, as it is, in energy particularly. But if we don't get it under control, it will get worse, and we will have to raise interest rates by more.
Let's get straight to our Lizzie Birding for more analysis. Lizzie, I mean, it is crazy to think that they're basically expecting a 5-quarter recession and they're hiking 50 basis points. I mean, do they feel powerless?
I'm sure they must, but they've had to make a decision and they've chosen to prioritise controlling inflation, no ifs, no buts, and because they see it rising not just into double digits, but above 13%. You know, it's a difficult choice to make. The forecasts are gloomy, but you'd hope that they're gloomier than the reality is going to be because, of course, they can't take account of what's going to happen in fiscal policy, and we're about to get a new Prime Minister. Though you could argue that perhaps this is going to become some sort of self-fulfilling prophecy because it's so bleak. Frankly, I've woken up depressed this morning. I'm sure you feel it too. It's on the front page of every UK national newspaper this morning. And I think you can really feel the absence of Boris Johnson. Usually you'd have his boosterish filter on this economic news, but he's on holiday, so's the Chancellor. And all we've got is this grim outlook from the grey officials at the BOE.
Yeah, and you have to wonder how that plays into, of course, you know, people asking for raises and companies and things like that. Okay, QT, we were hoping or expecting, the market was expecting to have more than that line on QT, and we didn't really get it.
Yeah, you tried.
I tried.
Andrew Bailey's been on broadcast this morning saying that it's not going to affect markets, that they're doing all of this asset selling. But really, this is something the Bank of England has never done, nor has any other central bank. We found out yesterday that there's going to be £80 billion of QT in the first year, £10 billion a quarter, and the emphasis was that interest rates remain the active tool. That's why they didn't want to tell you how much it's worth in terms of basis points of rate hikes, but really it does seem hard to imagine markets can ignore this.
Yeah, 100%. And then we're also speaking to the chief economist, of course, Hugh Pillen. We'll try and figure out, for example, what it will take for them not to go ahead with the QT, right? I don't know if there's another meltdown or something like that. Lizzie, thank you so much. As always, great reporting. Our Lizzie Burden there. Now, don't miss our interview, our exclusive interview with the Bank of England's chief economist, Hugh Pill. That's at 9:40 a.m. UK time. So in about 30 minutes from now, you can send questions through IB plus TV Go, or you can message me directly on Twitter. Now, to talk about the UK, we're joined by Bruna Skaraka, UK economist at Morgan Stanley. Bruna, thank you for joining us. I mean, it is pretty crazy to see the forecast being so gloomy from the Bank of England. Are they predicting the worst because they also don't know who will be Prime Minister?
Of course. Well, the Bank of England works with a certain set of assumptions. The first one, of course, is fiscal policy as it is announced. So moving forward, they're not assuming any further fiscal support. The second assumption is bank rate, of course, as implied by the markets. So there is an element here of if you're expecting further fiscal support, as indeed I believe everyone is, given the announcements in the leadership campaign, the actual outturn next year could be a bit better than what the Bank of England projected. But their hands are tied. They're working with fiscal policy as assumed, as announced.
Bruna, I spoke to the Bank of England governor yesterday, and I really tried to push him. I know they don't talk about the pound, but I really tried to understand, you know, this has, again, a huge impact on what they're trying to do. Are we in a pound crisis?
No, I believe that's not the case. Look, the Bank of England outlined their kind of thinking on sterling in some, I would say, detail yesterday in the minutes. They basically said, look, trade-weighted sterling is down compared to the May MPC meeting. However, about 60% of that move is relative to the dollar. So I do think that there is an element here of that dollar move that they can't necessarily impact. But in terms of why they take the currency into account, of course, Governor Bailey says that often a lot of our inflation overshoot is imported via energy and food prices. About 80% of that overshoot is imported. And so, of course, the currency here matters, and it's an almost instantaneous way of impacting financial conditions.
How much, Bruna, should we worry really about unemployment in this country?
Of course. Well, look, the Bank of England assumes that the unemployment rate will start rising in the first quarter of 2023. I think the first indicator they'll be looking at in the run-up to their September and November meeting are vacancies, actually. They talked a lot yesterday at the press conference and in the NPR about how elevated that ratio of vacancy per unemployment is. And I think if they see vacancies falling down as demand growth slows, perhaps they could move back to a lower gear of tightening to 25 basis points as opposed to 50. In terms of whether the unemployment rate will rise, well, if we do get some supply back, and of course the economy is slowing down, then we could see an increase. But here at Morgan Stanley, we are a bit more constructive than the bank is at the moment.
Bruna, do you think, and this is something that we'll try and get also from Hugh Pill and, you know, or the governor when we get to speak to them, longer term, are interest rates in the UK going to be higher or lower than what the ECB will set and what the Fed will set?
Look, the UK is in the middle of, geographically and in terms of monetary policy of the US and the euro area. We have a very tight labor market. So in that sense, we're similar to the US, but of course, we're exposed to the same energy shock as Europe is. Of course, we don't get our gas supply from Russia anymore, but we are exposed to European gas prices. And so being in between means that, energy price increases means lower growth. That's exactly what the Bank of England is forecasting. But a tight labor market means higher wage growth than what we've seen in Europe. And that, of course, means tighter monetary policy. So here at Morgan Stanley, that's exactly what we think will happen moving forward. We have the Fed funds rate higher than the BOE bank rate, and indeed the bank rate higher than the default rate in the euro area.
So, Bruna, give me a sense of, I know we're, it's more politics, but we have a leadership race. Depending on who becomes prime minister, will the UK outlook significantly change economically?
Look, I can give you our growth forecasts for next year, which are basically flat. The Bank of England is working with a 1.5% contraction on the year. I think the first step to think about is, of course, the energy price increase in the fourth quarter. The energy cap, the utility bills cap, will increase by far more than, for example, what former Chancellor Sunak expected would be the case when he gave that fiscal statement in late May. On our calculation, if the Treasury wants to cover the same relative proportion of that utility bills increase, as was the case in late May, they would have to provide about £14 billion of extra spending for utility bills alone. Of course, one of the leadership contenders is talking about tax cuts as well. We do think that some of the tax cuts that are mentioned, which are mentioned, I do think have lower multiplier on growth than, for example, infrastructure investment and things like that, but they will help with boosting growth through 2023, we think. So in that sense, we're a bit more constructive on growth, assuming further fiscal easing than the Bank of England is.
Bruna, thank you so much. Bruna Scarica, their UK economist at Morgan Stanley, joining us, of course, on the back of that Bank of England decision. Now, we have a headline like we've rarely seen. This is from the Ministry of Foreign Affairs of China. China has just announced sanctions on U.S. House Speaker Nancy Pelosi. Now, this is, of course, 3 days after she visited Taiwan. Unclear what these sanctions are. Is it personal sanctions? Is it on bank accounts? Or is it just more of a symbolic sanctions that she can't go into China? And how problematic would that be going forward? So we'll dig deeper to try and understand exactly what these sanctions could look like. Coming up, U.S. Secretary of State Antony Blinken accuses China of seeking to change the status quo in the Taiwan Strait. So we'll have plenty more on that geopolitical tension with those sanctions being announced on U.S. House Speaker Nancy Pelosi. This is Bloomberg.
record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. U.S. Secretary of State Antony Blinken says China has chosen to overreact to Nancy Pelosi's visit to Taiwan. This comes after Japan said China likely fired missiles over Taiwan during yesterday's military drills. If confirmed, it would be a major escalation, as China have never flown missiles over the island itself before. Tokyo estimated that 5 ballistic missiles landed in Japan's exclusive economic zone and 4 probably flew over the island.
China has chosen to overreact and use Speaker Pelosi's visit as a pretext to increase provocative military activity in and around the Taiwan Strait.
Now, U.S. health officials have declared monkeypox a public health emergency, a step aimed at raising access to more funding to fight the virus. Monkeypox has spread to more than 26,000 people globally in just a few months, leading the WHO to declare the outbreak a public health emergency of international concern last month. And South Korea has launched its first home-developed lunar orbiter, becoming the 7th country to join the already competitive race to send spacecraft into the moon. The craft lifted off from Cape Canaveral in Florida just after 7 p.m. local time and successfully separated from Falcon 9. Francine.
Leanne, thank you so much. We'll have plenty more, of course, on the markets, too. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
No one covers the world like Bloomberg.
There's a sense they'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bailey's warning after the biggest rate hike in 27 years. The Bank of England governor tells the UK to brace for a contraction amid unrelenting inflation. Jobs in focus while the U.S. labor market may be cooling. Today's payrolls report is expected to show hiring holding up. Plus, with a whimper or with a bang as earnings season winds down, we'll break down the top trends and key takeaways. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So Nancy Pelosi's visit to Taiwan has sparked a retaliation. The U.S. House Speaker remains undeterred, saying China cannot stop U.S. officials from visiting the island. Well, China's foreign ministry has responded with sanctions on Pelosi herself. Taiwan, meanwhile, says Beijing sent warships across Taiwan Strait, dividing line today. An unusual move, signaling its largest drills in decades around the islands were continuing for a second day. Well, U.S. Secretary of State Antony Blinken called the move an overreaction. Let's bring in Cindy Wang, who joins us from Taipei. So, Cindy, it's been quite a week. What's the latest update?
Yeah, exactly. That's quite a week. So the latest update we have today is that China, according to Taiwanese Defense Ministry, that China sent groups of warplanes and warships crossing the Strait Median Line as of 11 a.m. local time. So for the warplanes, we have seen that that's the third day in a row this week that China's warplanes are flying across the Strait Median Line for the third day. On Wednesday and Thursday, China has sent 22 warplanes respectively crossing the Strait Median Line. So this is the third day in a row. But for the warship part, it's more interesting because this is the first time in many years that Taiwan's Defense Ministry officially confirms that China sent warships crossing the Strait Median Line. So in response to that, Taiwan side, they issued the radio warnings. They deployed the air patrol and naval ship to monitor the situations. And it's very likely that for the next 48 hours before China finishes its military drills, we're going to see more provocative actions here.
Yeah, and Cindy, I was going to ask, I mean, you have a read on this more than probably anyone else. These are, provocations. Was it pretty much how we were expecting it to, to pan out, or is this a real escalation?
Well, I think that's a question many people here are also debating and trying to figure out. I think this, of course, is China's provocative action that's in response to U.S. House Speaker Nancy Pelosi's historic visit to Taipei. So China just want to signal that, well, they want to stress that their territorial integrity and sovereignty. So they think it's not right for U.S. House Speaker to visit Taipei. So that's a way to show their displeasure. But on the other hand, I think this historical visit to Taipei really has a very significant meaning for people in Taiwan here, because that just hugely boosts the visibility of Taiwan in the international community, and again, just highlight Taiwan's status as a bastion for democracy and freedom.
Cindy, I think about 15 minutes ago, we had news from the Ministry of Foreign Affairs of China that they were going to impose sanctions on Nancy Pelosi. Do we have any idea of what they look like? I mean, is it her and family members not being able to do business with China and Hong Kong or even entering it?
Yeah, so far we've just know that China announced the sanction on Nancy Pelosi as well as her family. We're waiting to see for more details, but I think the sanction move is probably expected by many people watching for this development because before Pelosi's visit to Taipei, China has already warned the U.S. of grave consequences if Pelosi does visit Taiwan. And so far we have seen China really has very strong reactions in terms of military actions. They're sending warplanes, warships, crossing the Strait Median Line. They're also having this economic retaliation targeting Taiwan, like banning the food imports from Taiwan's producers, as well as sand-ban exports to Taiwan. And also, we also see that many Taiwanese government websites suffering from many times cyber attack these days. So China is really like launching the various strong actions toward Taiwan and toward Pelosi's visit. And we're watching very closely for any more reactions from China in the following days.
Yeah, I definitely feel, Cindy, like things are being ratcheted up. Thank you so much, Cindy Wang, there joining us from Taipei. Now, this is what the markets are telling us. The U.S. equity futures holding to some of the gains that we saw earlier. European stocks also holding to those. Technology shares are actually advancing. Investors bracing for the monthly U.S. jobs report that are likely to enliven the recession debate. European stocks actually a bit of a reversal, down 0.2%. There were earlier gains, some 0.3%. Investors flocking back to defensive shares. Coming up, Tesla has cleared the way for a 3-to-1 stock split. More from its annual shareholders meeting next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Economics, finance, politics. This is Bloomberg Surveillance, or the edition of Francine Lacqua here in London. Now, Tesla's AGM took place last night at the company's Gigafactory in Austin, Texas. As expected, the electric vehicle maker approved a stock split, and Elon Musk's Q&A did definitely not disappoint. Never boring. Joining us now is Bloomberg's Laura Wright. Laura, what did we get? What is the significance, actually, of the stock split and the AGM in general?
Well, the stock split 3-for-1. It's significant because it democratizes Tesla's share price, making it cheaper for Tesla's highly engaged retail investor base. It will bring the share price down to around $300 a share from over $900 a share where it closed yesterday. Worth noting, the last stock split at Tesla took place in August of 2020. Elon Musk outlined his view that inflation will subside over the coming months. You might call that a contrarian call in the current environment, and provided a bullish update that Tesla could deliver 1.5 million vehicles by the end of 2022. If achieved, that follows a record first quarter of deliveries, and there was a hint, Francine, at a new factory.
Yeah, we might be able to announce another factory location later this year. Where should we? Okay, where should we build it? Okay, we got a lot of candidates. No, I'm half Canadian, so maybe I should, you know.
Francine, I might add, Matt Miller is absolutely delighted that the Cybertruck is on track to come online in mid-2023. I find the vehicle's angular design so flair.
Yeah, I quite like it, but then I liked Back to the Future with that really iconic car. Okay, the elephant in the room, Twitter. I love following this because this is like pure and simple Elon Musk, right? He engages with the room and he engages with this fight on Twitter.
Exactly, and it came up in the Q&A where Musk admitted that the only publicly traded companies that he owns are Tesla and Twitter. But this is an ugly legal battle with subpoenas and countersuits flying around. Although Musk admitted that he genuinely wanted to help the social media platform and he understands the company.
All right, we need a picture, actually, of the car, the Tesla car. We're going to get it to you, Laura. We're going to put it on social media and then do a little bit of a poll on who likes and who doesn't. Yeah. Laura right there with the very latest on some of these tech companies. Coming up, the Bank of England warns the UK to brace for recession after the biggest rate hike in 27 years. Don't miss our exclusive interview with the central bank's chief economist, Hugh Pill. That's coming up next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
when big tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
We will get inflation back to target. There's no question about that. So that's my message to people in the street. Now, of course, it's very hard. I mean, it is very hard, particularly for those on low incomes in this country who are much more affected by inflation, which is concentrated, as it is, in energy particularly. But if we don't get it under control, it will get worse, and we will have to raise interest rates by more.
Well, that was the Bank of England Governor Andrew Bailey on inflation and the prospects of a UK recession. Welcome to our TV viewers and radio listeners on Bloomberg. We're delighted now to be joined for an exclusive conversation by Hugh Pill, Chief Economist at the Bank of England, really the man of the hour. So many questions, Hugh. First of all, thank you so much for making the time to come on Bloomberg, but so many questions on whether this time around we can really trust your forecast. What are your models? Are your models broken?
Well, I think you have to see our forecasts against the background of the news we're facing and the magnitude of changes in developments in the economy. So as I think was emphasized by my colleagues who spoke yesterday, even since May, we've seen a doubling of the sort of relevant measures of wholesale gas prices in Europe. And we know that those are the key elements that feed through into energy utility bills that households in the UK are going to face. And, you know, we've made the calculations on the back of the announcement that was made yesterday morning by Ofgem. And that suggests, as we've reported in our publications yesterday, that, you know, the cap will rise to £3,500. I mean, it's only 6 months ago, it was less than £2,000. So I think we have to understand that the scale of the shocks affecting the UK economy, particularly affecting the households in the economy, are really very large. And our forecasts have to change to reflect that. When we're taking policy decisions, we're not prisoners of any single forecast. Yeah. And I think one of the things that was emphasized yesterday by the governor is we've done a range of analysis with different assumptions about energy prices, different assumptions about interest rates and so forth. And across that set of analysis, there are certain key messages that come out. Yeah. First key message, I think, is that across that range, we will see a recession. The recession is the consequence of energy price rises we've seen in the past.
Well, 5 quarters of a downturn, right? It's more than a recession. It's like a protracted downturn.
Right, and I think that's a reflection of the magnitude of this increase coming from energy prices into household incomes here in the UK. And the second thing is we will see inflation go up, because the other side of this increase in energy prices is the increase in inflation. And then the third element is, and this is what the governor was just referring to, is in all our analysis, partly due to our own efforts, but also on the assumption that energy prices will eventually stabilize, we do see inflation coming back towards target towards the end of our forecast.
Is this worst case scenario, so a gas embargo, and is it also with possible, you know, fiscal expenditure from Liz Truss if she becomes prime minister? How difficult is it to know what the prime minister does, the next one?
Well, I mean, I think there are two things this year. On the energy prices, our baseline scenario is just based on the assumption that we follow futures. We can see those on your screens for the next 6 months, and then we lock that in. That is a locking in gas prices, oil prices at historically high levels, which persist indefinitely. Yeah. And for the UK, which is an importer of energy, that implies that there is this prolonged squeeze on real incomes, which is a big feature of our forecast. Regarding the fiscal side, of course, I mean, we're in a slightly complicated, shall we say, political situation. I'm not going to comment on that, as others have not either.
But it changes everything.
But I think a key thing is we are making an assumption in our forecast on announced government policies, the most recent of which is the the May adjustments that we've seen for adjusting the gas. But crucially, I think this is important, is, I'll repeat the same thing again, we are not prisoners of the baseline published forecast yesterday. And in thinking our policy, we are, of course, taking into account risks to all these conditional assumptions, including the fiscal.
But inflation also feels much more embedded, right? So at what point is it to a point of where there's a spiral and it's almost impossible to keep control of it?
Right. So I think your point about embedding, that is a key point. So when you say it feels much more embedded, the reason why inflation is going to 13% in our forecast is not really of itself an embedding story. It's a story coming from energy prices. The direct effect of energy prices on inflation over the next year at the peak amount to about 6.5 percentage points. The indirect effects, the fact that energy price rises mean it's more expensive to light the studio and so forth, so feeds through into service. We think that's about another third. Right. So around 8 to 9 percentage points of reaching 13% are coming really from this rise in energy prices. You're right, though, that what matters for us, what we can do something about, as we've emphasized in our statements of late, is that persistent component of overall inflation, that part of inflation that is still there into 2-3 years' time, that is still able to be responded to by policy decisions we take today, given the lags that it takes for our policy decisions taken today to work their way through to price developments.
We did a bit of research. You know what's the most Googled question on Google for the UK economy today is, do I buy a house price right now? Buying a house during a recession. Should I be buying a house right now? What impact does this have, given mortgages are going up, given it's, I think, £1,000 more expensive for house buyers paying that mortgage on average? What does it mean for the housing market?
Well, housing market, first of all, I wouldn't overemphasize from the point of view our assessment of the economy. I mean, the housing market is important, but it's not something we would give a status to beyond the other important elements. I mean, of course, fundamentally, what we are trying to do with our interest rate increases is to slow the momentum in the economy in order to contain inflation. I mean, that's what the agenda for monetary policy is right now, given inflation is so high and potential persistence there. Part of that will be operating through and via the housing market. I mean, you mentioned the point that mortgage payments will go up. I mean, what I'd again emphasize is what you say is true. That is part of a process that is slowing down the housing market, slowing down the economy. But it's also true that is smaller than the impact of this rise in energy prices, right? So I think we can distract ourselves from the big story if we begin to the way I would see it is, the way I'd emphasize is, we've seen this big shock to energy prices that has pushed up inflation, squeezed incomes. There is an interest rate response to that to constrain inflation, and that is partly working through the housing markets, which we would expect to cool. My colleagues on the financial stability part of the bank, of course, do their own analysis, and at the moment, at least, they think there's some resilience there. We're not expecting to see the sort of dramatic downturn that we've seen in the past.
Given what you've just beautifully explained, how likely is it that we get another 50 basis point hike in September?
Well, we're going to take decisions, as we always do, but I'd emphasize one step at a time, one meeting at a time. So I don't think you can read in to subsequent meetings the fact we made a 50 basis point change. And I'd caution against that. I think a careful reading of our statement yesterday would be consistent with the view that, as I think I said last time I was here, we're trying to ensure there's an element of flexibility in the framework. For two reasons. One, there is a diversity of views across members of the committee, which needs to be encompassed. And for any individual on the committee, at least myself, given the uncertainties we face, I think we need flexibility either to go further or to stay where we are, and the pace at which we go further to be varied according to circumstances.
Do you feel like you're behind the curve? I mean, I know that a lot of the UK press are going after the bank.
Yeah. I mean, I don't think we're behind the curve. I think a key element here is when you think about the persistent element of inflation that we're focused on, that's an element which by its nature is a slow-moving element. If you think about the impact of monetary policy, because of the lags that are in the system that I just mentioned, the impact of monetary policy on the economy is a slow-moving phenomenon. So what we're trying to do here is match those slower-moving developments in persistent inflation with an appropriate impact of monetary policy. And I don't think that is something that is about 1 month here or there. That's about something that's going to last over a period of years.
But how can the bank be forward-looking if, you know, inflation and employment are basically lagging? So you see them too late.
Yeah. Well, we can be forward-looking because we make forecasts. I mean, as I said, and as the governor said yesterday, those forecasts are difficult now, given the uncertainties we face. How can we make our decisions more robust in the face of those forecasts? Well, we look at a variety of different analyses. We look at a variety of different scenarios. We published many of those yesterday. And crucially, I think what we're trying to do is always extract from this broad set of information we see that component which informs us about this persistent element of inflation that's still going to be there in 2 or 3 years' time.
Hugh, the bank did also get some praise in saying, like, look, you were the first ones, you were honest, you're painting this very complicated picture with this pretty horrific recession. Longer term, do you think interest rates in the UK will be higher than in the US and the ECB?
Well, I mean, what's key for us is that we get inflation to target. If we get inflation to target, then interest rates will be, we hope, broadly speaking, at some slightly positive premium to that level of inflation, reflecting real returns in the economy. So, the real rate of interest is the nominal rate of interest that we're setting, take away inflation. That gap should be positive. We were not expecting a repeat of the experiences of the past, of my childhood, where interest rates were going sky high. We think that the equilibrium level of interest rate, if you like, that's a very vague concept, difficult to estimate, but we think it's much lower now than it was in previous episodes.
So around what level?
Well, I mean, I'm always cautious. You've asked me that before, too. I'm always cautious because I think it's a very uncertain level. In nominal terms, right, so just to emphasize, if we, as we're intending to do, and I expect us to do, and people should have confidence in us doing, if we get inflation back to target of 2%, then nominal interest rates will return to levels, broadly speaking, in that kind of range as well.
Okay, do you see interest rates peaking around 3%?
Well, I know that's what markets are currently pricing.
Yes.
I don't want to be pinned down. We will do with policy and with interest rates as our active instrument what we need to do in the light of events, in the face of circumstances, on this meeting basis that I've described, in order to achieve our target.
I know you don't want to be pinned down, but are they off, or are they pretty much in that range? What are markets getting wrong?
I'm not sure markets are getting too much wrong. I mean, personally, I think we are in a process of transition from a long, prolonged period, basically since the onset of the global financial crisis. That's almost 15 years ago now, from where monetary policy has been very easy. Monetary policy has had interest rates close to their lower bound. We've been doing QE. We're clearly extracting ourselves from that period, which lasted for a very long time, as the world changes. That process of extraction requires a certain element of caution because there's a danger, having gone, in a way, from one extreme with monetary policy. I think we have to guard against, falling into the trap of going to the opposite extreme. And, we're in a process of trying to calibrate interest rates, calibrate our policy stance to achieve our goal in a challenging environment, but in an environment where there are risks on both sides. There's a risk of doing too much and exacerbating a recession and prolonging a recession, which we think is already going to be there. There's also, of course, a risk of doing too little and allowing inflation to become embedded. So we don't want to oversteer, we don't want to understeer.
What's the less mistake? I know there's like a Goldilocks, but...
Right, well, of course, I mean, in assessing whether we're oversteering or understeering, we are thinking about those risks. Yeah. At the moment, I mean, our policy decision reflects the fact that this fear of embeddedness is one that we have to respond to more.
Hugh, I could speak to you for like an hour. I only have 1 minute on QT. How should we look at QT? So first of all, is it really that difficult to give the correlation between basis point in terms and how much QT impact will have?
Right, so I think there are two questions there. First question is it easy to give you a number, whatever, X base points? I think that is a very difficult question.
Yep.
And it's a difficult question because, as we have published in our own document a few months ago, I can hear the music, so you want me to stop. The short answer is, I think QT will probably have a tightening effect. Yeah. It'll come through asset prices. We will see those asset prices. We will set interest rates incorporating those impact of those asset prices in order to get inflation back to target.
Hugh, 1 hour next time, you and I, because we have a lot to talk about. Thank you so much for your time today. The chief economist there of the Bank of England, Hugh Pill. We'll have plenty more throughout the day. Bloomberg Surveillance Early Edition continues. AI is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change.
Reinventing climate news on TV, Quick Take, and Bloomberg.com.
It's an interesting economy at the moment with this very tight labour market.
We've hit a little bit of a floor in terms of growth.
We're going through a period where the economy appears to be weakening further. We may or may not be in a recession.
Come on, we're going to go into recession. Major economies are going to go into recession.
The Fed is hiking pretty aggressively into an economy that's very clearly slowing down. I don't know how that ends well.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. What the U.S. jobs report will tell us about recession. The latest unemployment numbers out today may show the labor market is cooling down. China strikes back at Pelosi. It plans to impose sanctions on the House Speaker for that visit to Taiwan. Meanwhile, Democrats have agreed on a revised tax bill that would impose a levy on stock buybacks. And the world's richest person sees signs that the global economy has gone past peak inflation. Tesla CEO Elon Musk says the car maker's costs are trending downwards. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, a lot to discuss today when it comes to the payroll picture in the US. But before that, equities, risk assets seem to be losing their cool just a little bit.
A little bit, but it depends where in the world you look, Anna. Of course, everyone is eagerly awaiting that jobs report in about 3.5 hours' time. But in Asia overnight, the trading week ended before we get that data. And actually, it largely was quite positive. The MSCI Asia Pacific Index as a whole was up about 0.9%. What's interesting is that Taiwan was outperforming. The Taiwan benchmark up 2.25%, even as we have an escalation in Chinese military drills around the island. We'll have more on that story in just a moment. But interesting to see risk sentiment doing okay there. Now, the other story related to China continues to be the turmoil in the property sector, demand for certain commodities like iron ore, but we have reports of about 10 steel makers in China restarting operations. More are expected next week. So that lifting iron ore futures by about 3.8% in Singapore, trading just under $110 a barrel. But of course, that was snapping a 5-day losing streak, and still those prices are down on the week. Finally, in foreign exchange, the big outperformer in Asia is the Thai baht, stronger against the dollar by about 0.9%. That is after inflation hit a 14-year two-year high. So that is ramping up bets that we may actually get a hike out of the Bank of Thailand next week, Matt.
All right, so more hikes from central banks, and we still see real strength in the Asian session. In terms of the U.S. futures, we're looking at not a lot of action. And frankly, when you have such a big release, you do see a lot of traders sitting on their hands and humans actually turning off the computers until the numbers come out so that they can actually make decisions themselves instead of having the algorithms do everything as usual. Bloomberg U.S. Dollar Index, right now a little change, but a little bit stronger. So maybe some people are seeking safety in assets like the dollar, in assets like the 10-year bond. You can see the yield coming down just a bit, not even 1 full basis point, but 268.27 is a fairly low level that we're looking at right now that shows investors have really piled into the bond market, telling a different sign than the equities markets over the last month, that the bond traders or bond investors are waiting for a recession while equity investors think that maybe the Fed's going to turn around. Bitcoin, by the way, is up pretty strong right now, 3%. Of course, this is from 5 o'clock yesterday, but over $23,000 right now, and it's a very correlated asset. So maybe this is some sign that we'll see more forward movement in terms of equities later when we get the open. Anna, what do you see in terms of Europe?
Yeah, that Bitcoin move is interesting, isn't it? Going that much higher, Matt. This is the European picture, and just up until about now, half an hour ago, we seem to be kind of sitting on our hands here in Europe as well, waiting for that jobs print out of the US, but things have deteriorated just in the last half hour or so. We're still waiting for the data. We are digesting earnings reports, and we're seeing a little bit of deterioration in sentiment as we do that. Let's have a look at some of the sectors on the move then, and we have seen retail as being quite a perhaps surprise area of strength in the last couple of days or so. That continues to be the case today. Also, basic resources, that sector going higher, despite other sectors bringing us a little bit lower across Europe. Into the earnings stories, and WPP, the massive advertising business listed here in London. This is an interesting one. They raised their guidance, which you might have thought would send the stock higher, but not as much as peers, seems to be the conclusion from some of the analysts, and that stock down by 6.8%, a brutal assessment there. DPW, this is Deutsche Post, the owner of DHL, competitor to FedEx, of course. They've been benefiting from freight rates of the past, so even if they're talking about those freight rates normalizing, they still see in the sort of rear view mirror a 5.8% gain in their share price, reflecting that positive performance that they reported this morning. And here I've got the pound for you, Kaylee, and this is just a picture of keep calm and carry on. We have the central bank here in the UK now saying that inflation will go above 13%. That is their forecast, of course. They're also predicting now a recession which could go just shy of 2 years. Even if it won't be deep, it could be long, is the assessments of the Bank of England. With all of that, we don't really see much movement in the pound. Is pretty much where it was yesterday before the Bank of England spoke. There's been volatility in the meantime, but there we are.
All right, keep calm and carry on, a motto to live by, Anna. We'll see if the markets can keep calm today through a series of events that we need to watch out for, including a number of earnings reports. DraftKings is among the companies that is scheduled to give results. Then this week's heavy dose of Fed speakers will continue. We have Richmond Fed President Tom Barkin scheduled to speak at 8 a.m. Eastern Time, and that is just before today's main event, the U.S. jobs report released at 8:30 a.m. Eastern. It's expected to show that hiring softened in July, but the labor market was still consistent with the U.S. economy in expansion, not recession. Let's get more on that now. Michael McKee, Bloomberg International Economics and Policy Correspondent, is joining us. Other than Fed Day, the Jobs Day is kind of like Mike's Super Bowl. So, Mike, what you watching today?
Well, this could be the most consequential or least consequential jobs report in a long time, and I'll tell you why. It's about the divergence that Matt was talking about between the people in the markets who think we're going to see recession and the people who think that the Fed needs to do more. The jobs numbers, 250,000 that you saw on the chart there, do suggest that there is a slowdown. But is it because they can't find workers, or is it because they're not hiring anymore and they're letting people go? That's going to be a key number to look at. And then unemployment. Here's unemployment and the JOLTS rate. This is the big argument in economics right now. We have a lot of job openings. We have a very low unemployment rate. To bring down the job vacancies, does unemployment have to go up significantly? That's one thing that people will be watching. No change is forecast for today. So at this point, it's a question of, does the Fed end up pedal to the metal, or do they have to back off? That's what people are going to be asking after the 8:30 number.
What I've been wondering is why so many people don't believe any of the Fed speakers that have come out and aren't listening to Jerome Powell at press conferences. The Fed is clearly saying we're going to continue raising rates.
Yeah, the argument is that the data are not necessarily saying you need to do that. You look at just this jobs report, the establishment versus the household surveys, two different surveys in there. The establishment has shown continued job creation, but the household numbers show that we're still losing jobs. So which one comes out on top today will have a sort of mental impact on people. And it's going to come down at the end of it all to what the famous American Yogi Berra once said. And you can explain to Anna who that is.
I think Kaylee might also be.
Oh, I am fully aware.
When you come to a fork in the road, he said, take it. So today we may see a fork in the road. You guys decide which one to take.
All right, well, we're looking forward to your coverage of that later this morning. Michael McKee, thank you so much. Of course, that full coverage of the U.S. jobs report will be coming on Bloomberg Surveillance. Plus, we'll have an issue with Labor Secretary Marty Walsh at 9:30 a.m. New York time. Now let's head to Washington. Democrats have agreed on a revised version of their tax and climate bill that would impose a levy on stock buybacks. Emily Wilkins, Bloomberg government reporter, joins us now with the details from D.C. So, Emily, this is what it took to get Kirsten Sinema on board.
Yes, but now Democrats do have all 50 senators they need to actually move forward with this plan. We're still waiting the exact details of exactly what was agreed to, but we know that that carried interest loophole that is going to remain. Senator Sinema wanted it to. She wanted to take any sort of closure of the loophole out of that bill. We also know we're going to see some tweaks on that 15% minimum corporate tax. This is something that's meant to really help out manufacturers. And we're also going to see a 1% tax on company stock buybacks. Now, Majority Leader Chuck Schumer said that this legislation is still going to reduce the deficit by $300 billion. It still contains various provisions on health care and on climate. Of course, one more big hurdle that Democrats have to look for here is the Senate parliamentarian. She's continuing to review the language. And remember, if she deems that something can't be passed via this reconciliation process, that's it as far as Democrats are going to be able to go. But they are expecting to move legislation beginning with a vote tomorrow, and they're hoping to do it before the end of the weekend.
Yeah, if that buyback levy stays in the bill, then what does that mean for stocks? An interesting one, Emily. Let's pivot to foreign policy, though. U.S. Secretary of State Anthony Blinken is accusing China of trying to change the status quo with a round of missile firings. Beijing conducted military exercises in the Taiwan Strait to show its unhappiness with House Speaker Nancy Pelosi's visit. Meanwhile, China has also announced sanctions on Nancy Pelosi and her immediate family members. This continues to develop, then, the tensions between China and the U.S. over the visit, even after it has passed.
Yes, I mean, even though both Biden and Pelosi, when they visited, made statements saying that the U.S. does not want to change in status quo with Taiwan, Beijing's response has raised a lot of concerns, as you heard from Secretary of State Anthony Blinken, saying that it now seems like China does want a change in the status quo. There are warships that have crossed the Taiwan Strait. There are the missiles, as you mentioned. There are the unspecified sanctions on Pelosi and her family, and those are mostly symbolic at this point, but there's certainly a lot of continuing tensions in that region. And Pelosi's trip, even though they were very careful with what they said, careful with what they did, it still very much inflamed tensions around the relationship between Washington and Beijing.
Emily, thanks very much. Bloomberg government reporter Emily Wilkins with us there from Washington. Now, in corporate news, Tesla shareholders approved a 3-for-1 stock split as the electric vehicle maker seeks to attract an even larger number of retail investors. CEO Elon Musk spoke at the company's annual shareholder meeting yesterday.
Yeah, we might be able to announce another factory location later this year. Where should we? Okay, where should we build it? Okay, we've got a lot of candidates. I'm half Canadian, so maybe I should, you know.
Elon Musk asking the audience there. Joining us now for more, Bloomberg's Laura Wright. Laura, what is the significance of the stock split then, and what did we learn from the AGM?
Good morning, Anna. Well, the significance is that it democratizes Tesla's share price. The market liked what it heard, with Tesla reacting positively ahead of the bell. The expectation is that Tesla's share price will fall to around $300 a share from over $900 a share where it closed yesterday. That, of course, will make Tesla more affordable for its highly engaged base of retail investors. Take note, the last time a stock split took place at the electric vehicle maker was back in August of 2020. Now, during the Q&A, Q&A, Elon Musk outlined his view that inflation will subside over the coming months. You might call that a contrarian view in the current environment. And Musk projected that Tesla could produce 1.5 million vehicle deliveries by the end of this year. If achieved, that follows from a record first quarter of deliveries. The elephant in the room, Twitter. Musk admitted that he genuinely wanted to help the social media platform, that he understands Twitter, but those comments come during an ugly legal battle with subpoenas and countersuits flying around. But I have to say, news that the Cybertruck is on track to be online in mid-2023 is very good news for Matt Miller, who adores the angular design of the vehicle.
I'm looking forward to seeing it. In terms of the rally in tech, we've seen almost double the gains of the S&P 500, almost a bull market. What are you hearing about whether or not it can be sustained?
Well, there is reticence to believe in this rally. Tech is flying in the face of analyst downgrades, which you can see here in the yellow. The Nasdaq 100 almost in a bull market, up nearly 20% from its bottom in mid-June. This is because the market has aligned with the view of more dovish Fed policy in the next 12 months, shown by Fed fund futures here in the blue. So what happens now? Well, data points such as NFPs today, US CPI next week will offer an indication of where Fed policy is going and what that means for tech.
All right, Bloomberg's Laura Wright, thank you so much. Now, speaking of tech, a number of other tech companies reported earnings after the bell yesterday, so let's get a check on how they're performing in pre-market trading. One of them being Lyft, of course, the ride hailer. It reported a record quarter of earnings. It really shows that the company's efforts of investment, trying to get those drivers back in the car to ease some of that shortage they are seeing, is paying off, and they have finally the supply in order to meet demand. So Lyft is up about 8.5% before the bell. It is an even bigger move, though, for another stock. We're talking a double-digit move of about 12% for DoorDash. It also reported a quarter that beat expectations, record order volume. So essentially what that means is even though the worst of the pandemic may be over, we're still all ordering food to eat on our couch. One more less positive story, though, is Warner Brothers Discovery. It's reported earnings after the bell. It had a loss, revenue coming up short. That stock is down about 10.5% before the bell, Anna.
Kaylee, a bit of breaking news that we should get to before we take a break. The White House is summoning the Chinese ambassador on Taiwan and the response to the Taiwan story. This, according to the Washington Post, saying the White House has summoned China's ambassador on Thursday to condemn Beijing's escalating actions against Taiwan and to reiterate that the U.S. does not want a crisis in the region. We've seen China, of course, sanctioning now Nancy Pelosi, as we heard earlier, and continuing to conduct those military drills around the island. We'll get back to the markets, and the focus of the markets really on the jobs report today. Hans Olsen, Chief Investment Officer at Fiduciary Trust Company, joins us shortly. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
A lot what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. Today, will we see the first cracks in the labor market?
There's another shoe out there to drop.
Will the labor economy break?
Can the Fed deflate the demand for labor in the economy without pushing up unemployment?
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
We still have a lot of slack in the labor market.
The labor market is going to be seen as to whether it keeps the light green on go, go, go for this Fed.
The July jobs report today on Bloomberg Television and Radio.
Happy Jobs Day. This is Bloomberg Surveillance Early Edition. We are simulcast on both radio and television, and we're waiting for the all-important non-farm payrolls number. Over the last few months, we've been beating the survey. For those of you listening on radio, I've got a chart in front of me showing the survey right now at 250,000. But we've seen these blue bars here are the actual reports, beats basically since the end of last year, with a couple notable exceptions. Joining us now is Julia Morpurgo, Bloomberg Credit and High Yield reporter. And Julia, what does the bond market do with this if it's a beat or a miss? Because it seems like bond traders are listening to the Fed speak much more closely and carefully than equities traders are.
Yes, definitely. I mean, the credit markets were really the first ones to react to the central bank's hawkish talk at the beginning of the year, and they're still the key to watch out for when it comes to how the Fed is going along its hiking path. So today, as you said, there's the expectations that the non-farm payrolls number will show 250,000 increase. If the numbers were to deviate from that consensus in either direction, we'll for sure see a big reaction in credit markets, both on the US side, but also on the European side. So yes, definitely all eyes of credit markets are onto the US numbers today.
Okay, yeah, so a big focus on that payrolls number. A big focus here in London yesterday was, of course, on the Bank of England and what they had to say about, yes, higher inflation, their forecasts go higher and higher, and the forecasts for the economy get weaker and weaker, and yet UK assets do very little in response, Julia. Did that come as a surprise?
Yes, so as you said, UK assets performed in a way that's a bit unusual when, for an interest rate hike, but that's because the interest rate hike was expected in the market, although it was the highest we've seen in 27 years. And we've seen the pound fall. We've seen credit actually hold up quite well. I mean, the reason for the pound fall is that, as you say, the outlook is quite gloomy, really. We get Governor Bailey flagging that a recession is coming in the fourth quarter and that inflation is to peak at 13.3% in October. So a real cost of living crisis is facing the country.
Well, Julia, of course, as we talk about the economic data in the UK and how that is painting a gloomier picture, the Federal Reserve here in the US is looking at the labor market saying, hey, things are still really strong. Is this going to be a classic case of if the print is good, it's bad news for the market? If it's bad, that's good news?
Yeah, well, if the print is good, then the Fed is gonna feel free to go ahead with its hiking path. Whilst if the numbers are not so good, then the Fed might want to stop and reconsider how fast it's hiking rates, and yeah, taking into account what the real economy is, how the real economy is performing, and how markets are reacting to it.
Julia, thanks very much. Thanks for joining us. Bloomberg's Julia Morpurgo on the markets. And you can get more detailed analysis and the thoughts of the Markets Live team. Go to NLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In the UK, the frontrunner to become the next prime minister says that a recession is not inevitable. Foreign Secretary Liz Truss spoke hours after the Bank of England warned that the UK is weeks from entering a recession that will last for more than a year. Truss told Sky News that the government can make it more likely the economy grows by cutting taxes. Another round of talks on the Iran nuclear deal are underway in Vienna. European Union diplomats tell Bloomberg that the divide between Iran and the U.S. has grown wider since the last negotiations ended. They say the remaining hurdles could be resolved within 72 hours, but that would require high-level political decisions in both Tehran and Washington. U.S. health officials have declared monkeypox a public health emergency. That's a step that will free up funding, treatments, and other services to fight the virus. The U.S. leads the world with known cases, more than 6,000 of them. And for the fourth month in a row, global food prices have dropped. A UN index of world food costs fell by more than 8.6% in July. The index is now at its lowest point since January, before Russia invaded Ukraine, a major food exporter. Still, prices remain elevated. People on low incomes are feeling the pinch as a cost of living crisis deepens. Coming up, we'll talk more about that inflationary story and what the labor report here in the U.S. will mean for the Federal Reserve. Hans Olsen, Chief Investment Officer of Fiduciary Trust Company, joins us next. This is Bloomberg.
700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. What the US jobs report will tell us about recession. The latest unemployment numbers are out today. They may show the labor market is cooling down. China strikes back at Pelosi. It plans to impose sanctions on the House Speaker for that visit to Taiwan. Meanwhile, Democrats have agreed to a revised tax bill that would impose a levy on stock buybacks. And the world's richest person sees signs that the global economy has gone past peak inflation. Tesla CEO Elon Musk says the car maker's costs are trending downwards. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And we're still reeling slightly from the Bank of England news of yesterday here. It seems asset prices shrugging it off, Matt, but certainly a lot of gloomy talk to digest.
Was there a Bank
over
of
in the
England?
US.
Did they have a Bank of England decision yesterday?
There was. We will mention it more later. But you're looking ahead to the jobs report, of course.
Yeah, of course, because this applies to the most important central bank in the world, right? The Fed is watching this closely, and so are investors. It looks like there's not a lot going on. It looks like ho-hum, you know, futures are doing nothing. The dollar is doing nothing. 10-year yield doing nothing. But there's so much kinetic energy here. It's like a spring that's compressed. And if you get a jobs number that's big on one side or the other, you're going to see it go, oh, baby. Maybe like Bitcoin. Right now, Bitcoin is up 3%. Go figure. I have no idea why. It's over $23,000, and it's typically a very correlated asset, but it's correlated to nothing I can see today. And if you get a good jobs print, you could see a lot of red right here. That could convince the equity market that the Fed really is going to continue raising interest rates to fight inflation. And of course, then we'll all be looking forward to the CPI and the inflation figures that are coming out next week.
Yep, on Wednesday, really looking forward to it. Kinetic energy. Matt Miller just bringing all of the energy, kinetic or not today. I'm trying to remember from physics what exactly kinetic is.
I can't remember either. I hope I got it right.
I know that there's something else that isn't kinetic, but I can't remember. Anyway, let's talk about the stocks moving in free market trading, because there were a lot of earnings out after the bell yesterday. Among the winners, Lyft, reporting a record quarter of profitability. It's up 8.5%. DoorDash had record order volumes. It's up about 12%. Cloudflare, which is a software business, gave a forecast that topped expectations. It is up actually nearly 20% before the bell. And for Carvana, of course, the used car company, this is a case of just results being better than feared. So that stock is up about 8%. Not all stocks so lucky, though. You also have a number of stocks moving to the downside after results. Warner Brothers Discovery reported a loss in the second quarter. The shares taking it on the chin, down about 10%. 10%. And for both Twilio, which is a software company, and Zillow, which is that online real estate company, they both gave forecasts that came up short of expectations. The reason why is just a softening macro environment. Of course, for the case of Zillow, it's a softening housing market. They are each down about 7%. And finally, Block, formerly Square, Jack Dorsey's company, missed expectations on payments volume. Part of that has to do with a drop in Bitcoin-related transactions. That stock dropping about 6.4% before the bell, Anna.
Interesting you mentioned housing. I've seen headlines from the UK to Canada, all looking a little gloomier on that front. Kaylee, not much upward energy here on European stocks, that's for sure. We've got the Stock 600 down by 0.2% as we head, well, we're in the second hour of trading here, in the third hour of trading, sorry, here in the European markets, but still waiting for that report for later on US jobs. WPP in focus from the media sector, down by 6.6%, despite the fact they increased their guidance today, but not as much as some of their peers, not as much as, therefore, some in the market had anticipated in the stock being punished as a result. Deutsche Post, the owner of DHL, that rival to FedEx, the stock is up by 5.4% today. They've been benefiting, of course, from the higher freight rates that we've seen as supply chains remained stuck to some degree, and people were paying over the odds to ship things. And so that has benefited them in the past, even if they see some normalization on that ahead. The pound, still pretty stable, really. I mean, 120, 130 is not all that far from where we started the day yesterday, and that was before we got forecasts of 13% inflation and a recession that could last for just shy of 2 years, Matt.
All right, I just want to point out that physics major Dan Curtis, our London producer, has pointed out its potential energy that these markets have right now.
That's the coiled spring one, right?
That's the coiled spring. Joining us is Hans Olsen, Chief Investment Officer at Fiduciary Trust. So Hans, which way is this energy going to be released after the jobs report? Do you think we have a beat or a miss? 250 is the survey.
Yeah, 250 is a survey. It wouldn't surprise me to see us come in slightly above what the expectations are. Either way, though, you know, whether it's a little below or a little above, the reality is that the economy is still growing at this juncture, and the reality that interest rates are going to go up have to remain firmly in investors' minds, and I'm not sure they quite are.
Why do you think the equity markets are so optimistic that the Fed's going to turn around and come back down? I mean, I guess the scenario involves a recession that they think scares Jay Powell and co. into giving us a Fed put. Is it just that they're used to that behavior?
Yeah, it's almost a bit of the return to the Goldilocks scenario, right? You remember that 20 years ago where everything will work out just fine. So if inflation will come down just enough to ameliorate sort of the Fed's need to raise interest rates. But at the end of the day, it's really hard to see how inflation comes down from what, roughly 9% right now to something sub 5 quick enough in order to prevent the Fed from having to lean into raising interest rates even faster. Put another way, even if we get to 5% on inflation, which would be remarkable, in any sort of way at this juncture, does a 10-year yield at 2.6, 2.7 make sense? Or in fact, does an entire structure of the yield curve below the inflation rate make sense on an ongoing basis?
Well, let's talk about what that yield means for an equity market that, as Matt said, has definitely reflected some optimism about a Fed pivot, but also is trying to relate to what the earnings we have seen. It's been quite a rally, and you have Michael Hartnett over at Bank of America saying essentially that's when you want to fade and take profit on. I'm wondering where you fall into that. Do you think it's a time to buy or a time to sell?
I tend to think that this is a time where probably in this month, if there's an opportunity to take some profits, take them. This seems to me, in short, like a counter trend rally in a bear market. The losses on the S&P 500 have been roughly cut in half over the last 45 days. If you look at the Qs, they're up almost 20%. Rallies like this inside a bear market are pretty common, and if you can, they can be traded. From our perspective, we'd be looking to take some gains in this to reset already the above level cash levels that we have in order to take advantage of the next down leg.
And of course, Hans, the rally hasn't just been in equities, it's in other risky assets as well. I mean, just take a look at high yield credit. Spreads have narrowed substantially from the highs of earlier this month. I mean, we're only at 441 basis points on high yield. What kind of signal does that send to you?
You know, Kaylee, that's an interesting point because it's as if that part of the bond market is buying into the equity market narrative, and that says to me that there's an opportunity there for a reset as well. It doesn't fit that you're going to have an inverted yield curve with high yield spreads coming in. A recession in the economy cannot be good for high yield.
Hans, good morning from London. I want to bring in some thoughts from here in London and some reference to the Bank of England, but really to ask whether it teaches us anything broader. Yesterday we heard from the BOE, they increased interest rates 50 basis points, but at the same time predict quite long, but not deep recession for the UK economy. I just want to play you a little bit of what we heard from Hugh Pill, the chief economist at the Bank of England.
We were not expecting a repeat of the experiences of the past, of my childhood, where interest rates were going sky high. We think that the equilibrium level of interest rate, if you like, that's a very vague concept, difficult to estimate, but we think it's much lower now than it was in previous episodes. If we get inflation back to target of 2%, then nominal interest rates will return to levels, broadly speaking, in that kind of range as well.
And I want to bring the Bank of England into this conversation about the US, Hans, to ask if there are any lessons at all, because this is a central bank hiking into a weakening economy with a tight labour market, which rings a few alarm bells about similarities.
Right. I think there was something else that Mr. Pill said in that interview that I thought was really interesting. He said right after that, he said, essentially their endpoint will be, what normal looks like for the Bank of England is an interest rate that is slightly above the inflation rate, right? So you have a real rate of interest that reflects real growth in the economy. That I thought was really revealing, refreshingly straightforward. And we don't get a lot of that in the American Fed. So I really like the messaging because it's very clear, it's consistent, and you don't have a lot of people running around at the Bank of England saying different things where we tend to have with the American Fed. So I think that was although a difficult message, a very clear message, and that probably would be welcomed in the American market, judging from what we see in the differences between the bond market and the equity market.
Yeah. Do you want central bankers to be so candid, Hans? I mean, clearly you want them to be honest and give their best faith assessments, but at the same time, it makes for pretty tough listening.
Yeah, I like this sort of the notion of saying less and meaning more, right? That could be very helpful to investors.
Okay, Hans, thanks so much. Thanks for joining us. Hans Olsen, Fiduciary Trust's CIO. Thanks for spending time with us here on Bloomberg Surveillance, the early edition. Coming up, China continues those military drills around Taiwan. More on China's response to Speaker Nancy Pelosi's Taiwan visit. That's next. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
China has chosen to overreact and use Speaker Pelosi's visit as a pretext to increase provocative military activity in and around the Taiwan Strait.
U.S. Secretary of State Antony Blinken speaking earlier at a news conference in Cambodia. That, of course, as Chinese warships have crossed the Taiwan Strait dividing line today. It's an unusual move, signaling that those large-scale military maneuvers around Taiwan are continuing. China also has announced sanctions on U.S. House Speaker Nancy Pelosi after her visit there, which, of course, is what has sparked this escalation in events. Rosalind Matheson, Bloomberg Senior Executive Editor for Government, joins us now for more. Roz, let's first start with those sanctions on the House Speaker. How significant are they?
Well, it is the most significant sanctions move against a U.S. official in terms of seniority to date. We've seen a lot of sanctions flying back and forth with officials from the U.S. and China in recent years. But what it tangibly does is not very much, unless Nancy Pelosi and her family perhaps were planning a summer holiday in China sometime soon. You imagine this will restrict her and her family from traveling there, but financial impact will be nothing. The main thing is, again, China is just trying to show their displeasure at her specifically, saying you made a choice to go to Taiwan this week and you've caused all these tensions that have spiraled in recent days, as you were noting, with all the military drills that are now underway. But certainly it's sending a message to her, but unlikely to affect her directly and her family as a result.
Rosalind, good morning. We're also seeing reports that the U.S. is summoning the Chinese ambassador to express displeasure and to try to make the point that they don't want to change the sort of status quo in the region. How are we seeing a big ramp up in tensions between these two countries, do we think, or do we think that this will die down?
Well, certainly, I think I've lost count of the number of ambassadors who've been summoned the past couple of days between the US, China, Japan and elsewhere over all of this. And that's a bit of a usual thing that countries tend to do in these moments. What's worth watching really particularly is the level to which China is responding militarily and how far to the line they're going with these drills that they're carrying out. Of course, we're seeing now that some of those missiles yesterday seem to have flown over Taiwan itself for the first time ever. And as you were just noting, China warships going up through the midline for the first time in a while. And so you're seeing a lot of extensive military pressure occurring on Taiwan and by de facto, of course, onto the US as a result. The question is, how far does that go? China's due to wrap up its drills in a couple of days. It might say, look, we've sent you a message. We've done all that in 4 days, and now let's all settle down again. But certainly, at least from the domestic perspective, China had to do something.
Yes, and just as we're speaking, Rosalind, we're just getting a few headlines coming through, which I'll bring to the audience's attention. China is saying it will halt climate change talks with the United States. It will cancel military dialogue with the United States and also cancel a work meeting with the U.S. Defense Ministry. So in answer to my question, I suppose, Rosalind, we haven't seen the worst of this. This continues to escalate.
Well, that's right. And that's one of the key fallout things we also want to watch is that because the US and China might have tensions over trade and technology and a bunch of different things, but they also are the two biggest economies on the planet. And in many ways, there are things they need to cooperate on that are global challenges, energy prices, climate change, and so on. And if you have them, China now saying they're going to withdraw from some of those dialogues and conversations, then you could see a broader effect, obviously, from the events of this week.
You know, I wonder what the effect has been directly on businesses. When we saw Russia invade Ukraine, obviously a lot of businesses rushed, some faster than others, to pull their businesses out of Russia. And there was a lot of talk about China. Will that same thing happen if they invade Taiwan? In fact, we've seen Stellantis actually pull business, close a factory in China and say that they don't want to be the victim of cross sanctions, as has been the case for companies in other regions, clearly making the parallel. Do you see any other cases, Roz, of businesses saying, like, you know, this is too hot for us, we're out?
Not at this stage. I mean, interestingly, what you probably saw is companies over the longer term saying ideally they want to diversify their supply chains. That was a process that probably started under the former administration. Of course, Donald Trump was the one who kicked off a trade war with China, and you saw many companies then realizing they probably needed to think about diversity in their supply chain in the long run and perhaps relocating their operations to other parts of Asia. So that's been an ongoing process already for quite a few years, and you may not see an immediate reaction. Of course, the hope from many companies, no doubt, is that this does die down again in a matter of weeks. You see these gestures from China, but how far will it go? Because in the end, China, Taiwan, the US, Japan, none of these countries actually want a war.
Meanwhile, Roz, we're continuing to get headlines on those countermeasures China is imposing against the U.S. There are now 8 in total after Pelosi's trip to Taiwan. The 2 latest headlines crossing is China halting cooperation with the U.S. on crime fighting and canceling maritime military mechanism meetings with the U.S. So we have an understanding now of what those countermeasures are. Matt was just bringing up the case of Russia and the war in Ukraine. And what we have seen in that is that it is not the U.S. alone in retaliating against Russia. It has been a coalition of allies that has proved quite strong. For the issue of China, though, can the U.S. count on the backing of its allies to the same extent? Is there a sense that the columns are not so clearly divided in this case?
Well, certainly we saw the Group of 7 nations issue a statement of concern. You saw the EU issue statements of concern. But you also see a bit of anxiety because, of course, it's one thing for Russia to invade Ukraine. That's unlikely to draw in the rest of the world militarily to the same extent as if China were to invade Taiwan. That probably would draw on the US militarily in terms of troops on the ground. And so you see a sense of anxiety amongst some Asian nations in Southeast Asia and elsewhere, just like, hang on, we would actually prefer that this really cools down. And so you're seeing those statements being quite measured, and certainly probably some of the conversations going on is how can we all just walk this back? How can we diffuse this situation? And you see that in the US language as well from some of the officials and from Japan and other countries, is that everyone wants to walk this up and everyone has a point to make. And certainly the US has a point to make here, but no one really wants to see this tip over into an outright conflict.
Rosalind, thank you so much for your time. Very, very well-timed analysis for us as those headlines just crossed the Bloomberg terminal. Bloomberg's Rosalind Matheson with analysis of the relationship between the US and China right now. Now, while the Biden administration continues to weigh tensions with China, the US jobs report will take center stage in a few hours' time. Stay with Bloomberg for full coverage, of course, and plenty of analysis, plus an interview with the Labour Secretary, Marty Walsh. That's at 9:30 a.m. New York time. This is Bloomberg.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
We've had a very big shock.
Now is the time to be bold.
Fall in real incomes, another significant deterioration in the outlook for activity in the UK.
It is, of course, extremely worrying.
GDP growth in the UK has slowed, and the economy is now forecast to enter recession later this year.
But it is not inevitable. We can change the outcome, and we can make it more likely that the economy grows.
We in the Conservative Party need to get real and fast.
CPI inflation is now expected to peak at just over 13% in Q4.
The lights on the economy are flashing red, and the root cause is inflation.
UK officials speaking there after the Bank of England announced its decision yesterday to hike rates by the most since 1995, painting a dire picture whilst it was doing that for the UK economy. Now, July's US jobs report brings the latest chance to gauge the strength or weakness of the US economy. Tom Keene will help lead the coverage of today's report, of course, and he joins us now. Tom, take us to your thinking and your single best chart.
It's going to be interesting as I 8 ways to go here. Let's go to the chart of the year. This is going to be, I can't believe I've got a different chart of the year. I'm not willing to call it right now, but this is pretty close. This is what everyone's talking about, which is the percent of Americans employed. As you know, Anna, that it's about a fully employed America, back to the dismal 70s where the line slopes down, and up we go to the ginormous boom, mostly led by women employed through the 1980s up to the miracle of 1999.
Yeah,
and then a crisis and then a pandemic, and we barely made it back.
Yeah, it's a fantastic chart, especially on a day like today, Tom. When it comes to this employment report, who are you going to talk to about it on today's show?
We're going to lead strong with Dominic Constant for Global Wall Street. This is absolutely must. I'm going to cut to the chase. Constant thinks the worry warts are wrong. This is a Fed in control.
All right, Tom Keene, looking forward to the coverage from you, John, and Lisa over the next 3 hours. Thank you so much. And I am looking forward, Matt, to just seeing how this market reacts to the jobs report. I would assume that if we get a strong print, it's going to be a pretty negative reaction for risk assets.
Yeah, I think it'll be very interesting, a little bit of a reality check for sure if there's a strong print. I also want to point out that, you know, Tom's chart of the year, I saw that earlier. Dan Curtis sent it around in a chart note that were issued before the show. And I think it's really fascinating that we are almost back. I think just about 500,000 jobs away from pre-pandemic levels. So the Great Resignation has, in some senses, been washed away, and there's still almost 2 job openings for every unemployed person out there.
Yeah, exactly. The extent of the tightness in the US labor market, still a real preoccupation then for these markets. We will shed new light on that today with that jobs report due out in the next hours. And plenty of coverage, of course, coming on the next program, Surveillance. That lies ahead with Tom and John and Lisa. They will bring you all of the latest news flow surrounding the US labor market and the market response, the market reaction to that data. This is Bloomberg.
I think we need to think differently about, being enough. I think, in number of different respects, I think, we're trying to either prove ourselves or do too much. I think we have to realize that, as Black people, despite what society says about us, despite, what happens, we are enough. And so I think going forward in that headspace, I think is really important.
I think the pandemic really highlighted the importance of financial literacy. And in that, it's so important to understand, okay, like how do we budget? How do we plan for, unforeseen circumstances and really make sure that we're prepared for these events in the future. And through Blockchain Capital, that's why we really place a big emphasis on financial literacy in all forms, budgeting, retirement, investing, etc.
What motivates you guys to do this?
I think it's honestly the impact that we've already seen. It's something that we just want to keep going because we've seen students come in, learn everything that we teach them, and get really successful jobs on Wall Street, really change their trajectory, their career path. And so if we can keep doing that for the next 100 years, that's something that's satisfying for me.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
The Fed is hiking pretty aggressively into an economy that's very clearly slowing down.
We're going through a period where the economy appears to be weakening further.
What I worry is on the other side, that the Fed works too fast and too much.
They essentially must hike and must tighten policy if they don't see inflation coming down to 2%. Come on.
We're going to go into recession. Major economies are going to go into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures unchanged, TK on the S&P. The jobs number a few hours away.
Huge anticipation here, John, and I think a real mystery all in all to jobs. But what's really interesting, and we're going to address this in a moment, Global Wall Street, Dominic Constam to join us here in minutes. And I'm sorry, it's a Theory Friday, John. Theory matters today, and that's the guesstimate of where we'll be in 12 months.
Dom's looking for a soft landing in the US economy. We can build on that. TK, for me, we're all looking at 250K as the median estimate in our survey for payrolls a little bit later this morning. And many people asking the same question. Pockets of weakness through this economy right now. Does it show up in this labor market report, or is it too soon?
Ed Hyman and Julian Emanuel, I believe they clock in at a lesser number, 175. And there's that whole angst, John, of what claims are doing and where we're going. The dynamic here, and John, it's really squishy. It's the dynamic of jobs and maybe lack of jobs with wages, and let's call it Wages Friday.
The range is wide, Bramo. It always is. 320K at the high end, and at the low end, I think it's about 50K. So there you go.
I'm just trying to wrap my head around, is it Wages Friday? Is it Theory Friday? Or is it Jobs Friday?
Tom complains when it's ECI Friday, and now he wants to call it Wages Friday.
Exactly, or Theory Friday. But I think right now it is Jobs Friday, and we are looking to the labor market, in particular the participation rate. And Tom, you were highlighting this in your chart earlier this morning, and this is really the key question. How much slack is there? How much can we see a weakening without the unemployment rate going up significantly? What are we seeing from the JOLTS data? And then how does the Fed use this at a time when anecdotally, yes, things are weakening. Yes, not only that, you also are seeing prices come down in certain quarters at the same time that you've got that incredibly hot CPI and you have it around the world.
At the same time, you've got a market rally we need to discuss as well. 3 whole weeks of it on the NASDAQ, on the S&P 500. Tom, and we talked about this wall of doubt. All the banks lining up. Bank of America, Goldman, HSBC, Barclays. What did HSBC call this yesterday? Wishful thinking.
It's unloved, and what's interesting is the reaffirmation of not gloom. Gloom overdoes it, but the tentativeness, the timidity of this into the weekend is extraordinary, John. The timidity is off the chart.
It is Crystal Palace, Arsenal, Friday, Tom.
Yeah,
That's what it is. It is the sound of Premier League football.
It's not, guys. It's Padres Dodgers.
Is that
Friday.
what you're going to call it?
We're going to stay up late.
Padres Dodgers Friday.
It's like this is magical, John. This is magical.
No. It's just not working for me, Tom. Futures unchanged on the S&P, on the Nasdaq right now, down about 0.1%. I'll whip through the price action. Elisa's going to whip you through the day ahead. Yields are unchanged, basically, up not even a basis point at a 10-year, 269.72. Can we get used to this, Lisa? Crude with an 88 handle?
Yeah.
88.72, up 0.2%.
Yeah, and how much is this a short-term story versus a long-term story, and how much, we've been talking about this consistently throughout the year, how much does the decline in oil prices rely on China remaining in a zero-COVID policy and that demand not coming back online? The big number of the day, I would call it Jobs Friday or Non-Farm Payrolls Friday. We get that report at 8:30 a.m. John was just mentioning 250,000 is the estimate. I'm watching underneath that headline number. What do we see in average hourly earnings? We have seen them trending down just a little bit year over year. The expectation is for that to continue and go below 5% year over year to 4.9%. What does that tell us about how much of a non-wage spiral there is, how much the Fed has to respond to this element? In other words, also how much momentum there is in the labor market. There also is a host of Fed speak led off by Tom Barkin of the Richmond Fed. How much does he speak to this participation rate and to the compressed yield curve, the 210 spread, now at the lowest going back, the most inverted going back to year 2000. Is this a good thing? Does this mean that the Fed is having the effect that they want? Or does this concern them because they might be moving too fast and front-loading in a way that really does undermine momentum that could lead to some sort of soft landing? And at 9:30 a.m., U.S. Secretary of Labor Marty Walsh is joining Bloomberg Television with one and only John Farrow. I'm very curious to hear what he has to say with the messaging so tricky at a time where the Federal Reserve and even a lot of Congress members are saying we need the labor market to cool off in order for this economy to get some price control in the economy. This is not a comfortable message. And so how does he talk about that?
We'll have a very serious conversation on Bloomberg Radio as well. Lisa, thank you for that. Mike McKee and Tom want me to ask about the Red Sox, so I'll try and squeeze that in, Tom, at the end of the interview. Before we get to Secretary Walsh, we've got to talk about Secretary Blinken. TK out today saying that China has chosen to overreact to Speaker Pelosi's visit, and headline after headline just dropping around this story throughout this morning.
It's a movable feast right now, John, and into the weekend as well. You wonder when the White House will make some formal statement. I did notice the sanctions of China on Speaker Pelosi.
Any extra headlines, we'll bring them to you as we count our way down to Payrolls Friday, 8:30 Eastern Time. Joining us now is Dominic Constam, Head of Macro Strategy at Mizuho Americas. Dom, let's start here. Soft versus hard. You think we can engineer a soft landing, Dominic? Why?
Well, first of all, you've got to define what you mean by soft landing, and we define it in the context of the sensitivity of inflation to slower growth. So if inflation is very sensitive, then you're not going to give up that much growth in order to bring it down a lot. And there are essentially three things that kind of drive that view. A couple of them are very explicit in the Fed's view. One is that inflation expectations are coming down, and that links directly to lower inflation. That's kind of the Bullard view. That's about Fed credibility. The second thing is beverage curve, which is Waller's view, the idea that essentially excess demand for labor drives up wages, vacancies are too high, they're coming down now. We got that JOLTS report that gives you a ratio of 1.8 now of vacancies to unemployment, so that's a very positive thing. And the third thing, which I don't think a lot of people talk about, but it's pretty clear, is that profit margins actually expanded during COVID, so that meant companies were able to pass on cost inflation into higher prices directly, which is very, very unusual. They were able to do it because of the fiscal stimulus. That's gone. Those profit margins can absorb cost inflation. Even if wages don't come down, you can actually get inflation coming down. So there is this path to a soft landing. I don't see why people think it's such an elusive thing. Obviously, if it doesn't happen, then it's going to be a hard landing. But you've basically got several months where you really should be expecting a soft landing, I would argue.
Dominic, I want to talk about the way we push against the Phillips curve and maybe even the beverage curve as an exercise in Euclidean geometry. Do we really know where we are on the continuum of jobs and wages right now, or is it truly an unknown as we decide soft or hard landing?
Well, I think ex post, you sort of can see where we are, but going forward, there's a reasonable argument to say that maybe we don't really know. But ex post, since July last year, the betas of wages to unemployment are off the charts. I mean, there's been an amazing acceleration in wage inflation, and you see it in lots of different measures. You see it obviously in the ECI, you see it across age cohorts. So without question, there seems to be this sort of wage pressure. But that's when you look at the jobs report, you sort of focus on that decline in wage inflation, and if unemployment isn't really going up that much, that means that wage beta is just collapsing, which says that it's kind of reflecting the excess demand for labor that we've seen in vacancies. So I think there is a good argument to say that the Phillips curve will flatten back down again going forward. What I do is I look at the actual sectors in the labor market, because there are 4 sectors, a handful of sectors that really drove this wage story, and people don't focus on it. And it's like freight, health, leisure. Those are the sectors that were really COVID related, and those are the ones that are actually coming down quite fast. So again, it's another way of like digging deeper into data and getting a bit more optimistic that a soft landing is totally plausible. It may not be it may not be 100% certain, but it's certainly the most likely scenario at the moment, I would suggest.
Dominic, even if you're right theoretically, are you right politically at a time when the Fed is being pushed to do as much as possible? Are you right when you talk about a 2-year yield getting down to 2.5% from 3% now, at a time when the Fed is being charged with taking the helm and controlling inflation, even though their policy has a lagging effect?
So this is a great issue, because this defines the volatility in the front end, which has been tremendous. So we're very happy saying the long end is kind of well anchored. Soft landing, it's anchored, and hard landing, it will be anchored. It will be anchored there because the Fed will just have to do a lot more. So when you see the data, you kind of have to divide it into 2. If you see the wage data coming down a lot, and let's say jobs are kind of as expected, I can interpret that as consistent with a soft landing. Some people will interpret it as that it's not sustainable, and you still need a lot higher unemployment, and therefore the Fed has to be much more aggressive. And so you'll see the 2-year note struggling between those 2 scenarios. In the end, if actual inflation comes down, then yes, the 2.5% 2-year note is totally plausible. If we see inflation come down, the rates market, in my view, will do extremely well. The Fed does not need to go much further, and you'll end up with a very sort of constructive outcome, not just for interest rates, but also for risk assets. It's the uncertainty around that soft versus hard, and how different people are focusing on different things. Some people just do not believe that wage inflation can stay down unless unemployment goes up a lot, and that's why you get that volatility in the front end. But yes, net, the front end, in our view, will become a buy on the soft landing view. But either way, the back end is well anchored, and that's where you can sort of find a better value. And I think that's why the curve is obviously sustainably flat as well.
This is the perfect way to start the weekend, TK. The optimism of Dominic Constant. I think we'll all have 10 rounds of whatever Tom's been having.
What I want to say here,
I think that's perfect.
John, Dom and I have known each other for years. I believe he didn't have his first gray hair at the time. And what's important here to what Dr. Constant is saying is, John, the rigor of the geometry he's talking about, and that's a rigor that you do hear from both parties, Waller and Summers. Folks, this is esoteric on a hot August Friday. John, this really matters in the debate, and you saw the heat yesterday from the Bank of England, which one day Dominic Constant is going to run.
You reckon? Dominic Constant, the Missouri Americas. Dom, good to catch up, sir, to get the alternative point of view on things. Very constructive. And Lisa, when you look at the data points, let's look at commodities too. Michael Hartnett out with a note this morning. Oil's down 28% since the June 16th equity market lows. Copper's down 23% since the June 16th equity market lows. The Nasdaq's up close to 20%.
Elon Musk coming out last night and seeing that every moment of his commodities complex has been coming down in terms of price over the past few months. Just idea being that inflation does seem to be rolling over.
It's amazing how a market rally changes the mood over the last 3 weeks. Just slowly. Futures on the S&P 500 unchanged. Great lineup through this morning. We'll catch up with Peter Oppenheimer of Goldman in the next hour on this equity market. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China is striking back at the US. Beijing announced it will impose unspecified sanctions on House Speaker Nancy Pelosi and her family for her visit this week to Taiwan. Meanwhile, China is canceling military and climate talks with the US, and Chinese military forces are still conducting exercises around Taiwan. Democrats have agreed on a revised version of their tax and climate bill. They will drop a provision that would have narrowed a tax break for carried interest. They also altered a minimum tax on corporations and added a new 1% tax on stock buybacks. A pivotal vote in the 50-50 Senate. Democrat Kristen Sinema says she'll back the revised plan. There are signs that conditions in the U.S. labor market are easing. The July jobs report is out today, 8:30 a.m. New York time. It's forecast to show that the U.S. added 250,000 jobs, whilst the unemployment rate held close to a 50-year low last week. Applications for state unemployment insurance rose slightly and was near the highest level since November. And in the UK, the front-runner to become the next Prime Minister says that a recession is not inevitable. Foreign Secretary Liz Truss spoke hours after the Bank of England warned that the UK is weeks from entering a recession that will last for more than a year. Truss told Sky News that the government can make it more likely the economy grows by cutting taxes. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
When big tech reports earnings,
another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, will we see the first cracks in the labor market?
There's another shoe out there to drop.
Will the labor economy break?
Can the Fed deflate the demand for labor in the economy without pushing up unemployment?
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
We still have a lot of slack in the labor market.
The labour market is going to be seen as to whether it keeps the light green on go, go, go for this Fed.
The July Jobs Report, today on Bloomberg Television and Radio.
China has chosen to overreact and use Speaker Pelosi's visit as a pretext to increase provocative military activity in and around the Taiwan Strait. The fact is, the Speaker's visit was peaceful. There is no justification for this extreme, disproportionate, and escalatory military response.
That was Secretary Blinken there accusing the Chinese of overreacting. From New York City this morning, good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, counting you down to payrolls Friday. The data a couple of hours away. Futures doing not much at all on the S&P 500. Unchanged on the Nasdaq 100, down a little more than 0.1%. Yields unchanged on a 10-year. Muted price action going into the big data point. 269.54 on a 10-year. TK down in D.C. I know the focus is on China at the moment, but some good news for this White House from Senator Sinema.
Well, it's good. We moved the legislation forward, I guess. I mean, that's the way to put it. Politico has a summary here of who's giving what to the senator from Arizona. She decided to come over here. David Gura over at NPR features it up today. And we go to our Emily Wilkins to actually find out what is going on. Emily Wilkins, let me cut to the chase. Is the senator from Phoenix beholden to the fat cats of Wall Street?
I mean, at this point, she has certainly advocated in their interest, making sure to remove that narrow restriction of the capital interest tax that was initially going to be in there. It's something that she has fought for from the very beginning. Initially, Senator Joe Manchin said he wanted that to remain, but she successfully pushed back because this is how it works if you're one of 50 Democratic senators.
You know, Emily, let me cut you off here because I think a lot of people on radio and TV want to know this. I get that Nadler of the Upper West Side, Maloney of the Upper East Side, or Schumer, the senator of New York, would be helpful to Goldman Sachs and a million others, KKR, you know the names of all the victims that watch us each and every day. Why is the senator from Arizona getting such substantial support from New York Wall Street?
Number one, she's been a senator who's been open to having their interests. And if companies have an opening, they are going to take advantage of that as far as lawmakers who are sympathetic to them. On the other hand, you think about her state, Arizona, that is a state with a lot of retirees. They do have a certain amount of wealth. They are hoping to keep that. She really has been targeted by a number of ads and a number of groups who have really pushed for her to continue supporting their interests. And she certainly delivered with this announcement that's come last night.
That's on one side, Emily. On the other hand, there was a new 1% excise tax put on share buybacks that will actually raise more revenue, or is projected to, that is being included in this legislation. Can you talk about how that came to pass, why that is okay with her and not the carried interest provision?
So one of the main things that Democrats are really trying to do with this legislation is make sure that they are reducing the deficit. And so the idea is that if you have that carried interest being removed, you're going to have to bring something else to be a revenue raiser. This 1% tax, this was always on the table as a potential consideration. It's just that Democrats didn't want to raise taxes too much, or at least Senator Joe Manchin and Senator Sinema didn't want to raise them too much. So they initially went with that minimum 15% corporate tax. and they decided not to do the 1%. But now that you've got the carried interest off the table, they're bringing that back, and they're having the 1% tax for companies who do stock buybacks. Majority Leader Chuck Schumer says that he believes that overall this package is going to reduce the deficit by $300 billion. That's something that Democrats can really take back to their constituents, pitch them as a way that they're trying to be fiscally conservative during this time of high inflation, but also be able to get their objectives done on healthcare and climate.
So when does this get passed, Emily?
So we're going to see a procedural vote on the measure tomorrow, and then we're going to see a all-night vote-a-rama. Republicans are going to try and add amendments to this legend to kill it. No, it's vote-a-rama. We've also taken a look at the Senate parliamentarian, because she does have to fully sign off on this package, say that everything can go through this very special reconciliation process. But should those two things happen, I mean, Democrats are moving forward on this. We could see final passage perhaps this weekend, early next week, and the House has vowed to come back as soon as they can and actually move this legislation to President Biden's desk.
Emily, what can we, I don't know if we can talk about this on air, particularly on radio with the regulations we have, but what happens at a vote-a-rama?
So to vote-a-rama, basically Republicans and some Democrats will offer a number of amendments to this piece of legislation. Again, remember, we're using this special process called reconciliation. It allows Democrats to move the bill with only 50 votes, but it does give this opportunity for all of these amendments to be offered. And basically what Republicans are trying to do is craft particular amendments that some Democrats are going to feel urged to vote for and support, and then potentially once that amendment is added, hoping that that package does eventually go down. So it's going to be very interesting to kind of read the tea leaves on who votes for what winds up getting into the package at this point. But Democrats, just a few weeks ago, they thought they'd get absolutely nothing. Now they actually have legislation. They have agreement from all 50 senators. It's within their grasp. They're looking at a really tough midterm, and they want to get something done.
Emily Wilkins down in D.C. Emily, thank you. TK, of course, everything is relative, but things getting a little bit better for this White House. They've got a better story to tell now than they did a month ago.
No, way better to tell. There's just no question about it. Can turn around. I thought Greg Valliere was fascinating yesterday, John. Also about how the Republicans are giving it up. With the elections that we saw on Tuesday, there were some challenges there for the GOP, and of course that makes it relatively better for the Democrats.
Relatively so, Lisa. A little bit more balanced for that race for the Senate.
Yeah, well, I keep looking at gas prices. 50 straight days, more than 50 straight days of price declines for gasoline in the United States. How much will that alone give a popularity boost to the Democrats rather, at a time when they need it? And then they also have this legislative win. On the other hand, to your point, how much are we seeing a wholesale rally versus a really different message being sent from the bond market versus the stock market? And that's what I've been thinking about, because the stock market is saying something very positive. The bond market, it's a lot less clear in my mind.
I'm always uncomfortable when people say that, though, Lisa, as if these two worlds are in separate rooms and they don't talk to each other. And that's just not true.
Okay, but you have a JP Morgan model that came out and said that the S&P is currently implying about a 50% probability of recession, down from 91% probability a few months ago. And you actually saw the probability increase for the same model in the Treasury market. So yeah, perhaps they're talking to each other, perhaps they're somehow consistent and just have different timings. But there is a different message, at least in the short term, being sent here.
What is often the case, I think, is that you trade initially on lower yields, you take comfort from that, and then you start to realize why yields are lower. And Lisa, maybe you don't take much comfort from that at all.
The problem is, or perhaps the benefit for a lot of these companies, is that they can still make money, and that in some ways they're an inflation hedge. Even if you get a downturn, they are making more revenues in absolute terms, even if on a real basis they're not. And this is something Tom's been talking about a lot, and I think that could be something supporting earnings.
You two agree on something.
We do.
What a beautiful way to close out the week. That is lovely.
He's watching the game.
He's totally distracted. He is not dialed in at all. Futures unchanged on the S&P. In the bond market, unchanged too. Payrolls, 2 hours away. 250K is your estimate from New York. This is Bloomberg.
What is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City this Friday morning. Good morning. Equity futures shaping up as follows. Totally unchanged on the S&P. Muted price action, as you might expect, going into payrolls 2 hours away. On the Nasdaq, down about 0.1%. Off the lows of the middle of June, from June 16th, up by almost 20% on the Nasdaq 100. What a run that is, and we're heading for a third straight week of gains. We're doing that with this kind of move in the bond market, and this is what Bramo's talking about. A 17, 18 basis point move at the front end of the curve higher, and yet that's your performance in the equity market over the last week. Pretty phenomenal stuff. Up another basis point or two this morning, Lisa, on a 2-year to 3.0592%. The Fed and Fed speakers did everything we predicted that they would do. They talked up a hawkish game, and this equity market didn't really respond to it, Lisa.
Yeah, even as they talked up some sort of hawkishness, you saw on the long end of the yield curve, long-term bonds, those yields coming in. The opposite side of the story, also not very positive, and yet stock markets did not respond.
In the FX market, here's a picture for you. Take a look at euro dollar, then we'll take a look at cable quickly. On the euro, going into payrolls in about 2 hours from now, looking for 250K. We're set up as follows at 102.36. If you want to check in on the health of sterling, Tom, we managed to squeeze that again yesterday. Just a little bit of sterling strength in response to what we heard from the Bank of England. 121.34, some weakness right now. But TK, wow, the headlines in the UK this morning on the front pages of the newspaper, unbelievable for this Bank of England. Brutal.
Yeah, there's no measurement of this, folks. For those of you waking up in America, to describe the fury, and I don't mean that in terms of an opinion, but just the frenzy, the heat, the fury, John, across the United Kingdom media over Governor Bailey yesterday, I would call it unprecedented.
Mohammed Al-Arian, who I'll catch up with a little bit later this morning.
Oh, you will, on one of your other properties.
He wrote on Bloomberg Opinion, almost welcoming the honesty of this central bank to tell us what they really think about the future and just how wide the range of outcomes could actually be. They're acknowledging all of those things, Tom. Can you imagine, though, we talked about this yesterday, if the Federal Reserve came out and did those things?
I cannot imagine.
I don't even know if the Fed can do anything like that, Tom, even if they thought it.
Well, it's a different responsibility, but at the same time, I can't imagine it. There's no question about it. And, John, what's interesting with Bailey's comments is you've got to believe we're going to see the path, the trajectory, got it, rapidly from his really grim view.
So, Tom, we're talking about soft landing or hard landing here in the United States. BNP Paribas, in their research, crash landing. That's what it said after the Bank of England yesterday.
Yeah, what we're going to do right now is do a clinic on wages. Lisa mentioned that earlier. Sarah House joins us now, senior economist at Wells Fargo. Sarah, let me do the basics here. What's the difference between average hourly earnings and ECI earnings? Help our audience with this.
Sure. So the average hourly earnings numbers, which we'll get a look at today, they come from the household survey that's housed under the employment situation report. So they are more timely than the employment cost index, but the employment cost index, it's fixed for composition. And importantly, it also includes benefits, which is about 30% of labor costs for employers. So it's a more encompassing look at the overall total costs for employment and the wage pressures and essentially the inflation pressures stemming from the labor market. So two different surveys, two different methodologies.
Beautifully explained there. We'd love to do that. Sarah, what do they indicate right now? Do they both suggest an ebbing in wage pressures?
So they both suggest that overall labor cost pressures are easing a bit, more so in the average hourly earnings numbers, which we expect we'll see some further easing today, at least if you're looking on a 3-month annualized basis. But I think if you step back and you look at the overall rates of both, they are still pointing to a labor market that remains very strong and is contributing to above target inflation. So if you look at the ECI that we got for the second quarter, so wages and benefits are still growing at a 5.4% annualized pace in Q2. Now that was down from Q1, but even if you factor in some generous assumptions about productivity, which we're going to get a horrendous report here on that next week, I think you're still looking at labor cost pressures still noticeably above the Fed's 2% target. So, Fed might get some help on commodity prices. We're seeing things like goods pressures easing as transportation costs come down, but you really need the help from the labor market to bring inflation down to 2% on a sustainable pace. We're just not there yet.
Sarah, what does it tell you that we're still churning out these kind of payroll gains and yet unemployment hasn't moved lower? It's stabilized at 3.6%.
Yeah, so I think overall, there's still some catch up to do in terms of the employment numbers. And I think that explains part of the discrepancy between the GDP numbers for the first half versus the employment numbers. But I think in terms of how the unemployment rate has been so sticky, I think in part that's suggesting that the trend in participation is higher, although we've seen it back off over the past couple months. So I think that's going to be a hugely important number in today's jobs report. Do we begin to see that upward trend reassert itself, or are we looking at potentially still very sticky, low labor force participation? Because that also feeds back into where wage pressures might go if you're not getting help on the supply side of labor.
Just a few minutes ago, Dominic Constam came on the show and said that people were overestimating how much wages were increasing because it was really stemming from a few sectors that were really disrupted from the COVID pandemic. Is that what you've experienced, or do you see a sort of broader based wage gain that is going to be more alarming for the Fed and speaks to something other than the soft landing that some people are hoping for?
Yeah, so I think it's actually been a bit broader. So certainly you have some standout sectors in terms like leisure and hospitality, transportation and warehousing, where wages are up by double digits just over the past year, let alone since February 2020. But if you go back and you look at what's happened to the wage trends across a host of major sectors, so they are noticeably higher than what we were seeing over the last cycle. So that it extends to manufacturing, it extends to construction, it extends to professional and business services, it extends to education and health. And so I don't think you can really boil this down to just one sector. I think we are seeing broader price pressures coming from the labor market than just one or two industries.
At the risk of getting some anger from my co-host John Farrow here, is good news going to be bad news for markets, considering that a lot of people are hoping for the Fed to back off?
Well, I think that so much of this is going to come down to the composition. So unlike, I think, some of the other reports, it's not just about one number. I think it's going to be that intersection of the wage dynamics with participation, with the overall payroll numbers and the unemployment rate. And so I think an ideal situation for the Fed might be you see that participation rate coming back and wage growth cooling. So that suggests, again, you're getting help from the supply side. So that's really the easier way out for the Fed, which is going to limit how much the Fed will ultimately have to raise rates. And I think if you can still put up some pretty strong job numbers, a beat on the headline in terms of payrolls, if you are seeing that participation rate come back, if you are seeing wage growth cooling, I think overall that could be taken as a pretty good report.
Just for the record, I don't get angry, Lisa. And not with you, ever.
Not with me.
You sometimes, Tom. Sometimes. Yeah. Sarah, looking ahead to next week, CPI, August 10th. Can we just finish there? What are you looking for on that particular data point?
Yeah, so we're looking for another strong gain. So, the headline's going to be weaker just because you had that huge pullback in gasoline prices, but that shift from 1.3% to 0.2%, which is what we're looking for, it almost entirely stems from energy. You're going to get some temporary help from autos, but I think importantly, you're still going to see the core coming in at 0.5, 0.6% rate, so still very hot. And I think if you look at the year-over-year numbers for core, those are actually picking up. And so I think that's going to be very difficult for the Fed to see that compelling evidence that we are seeing underlying pressures in inflation cool here over the next few months in time for that September Fed meeting.
Sarah, awesome, as always. Sarah House there of Wells Fargo, looking ahead to payrolls a little bit later this morning. Then it's on to CPI next week on August 10th. And in our survey, I can give you a sneak peek of the numbers right now.
Please.
Sarah did that for everyone anyway. We're looking for headline to come down from 9.1 to 8.8. We're looking for core, strip out food, strip out energy, year over year, to come up to 6.1 from 5.9. And they're the year over year figures. Here on Wall Street, a lot of people will be very focused on the month over month core number. And that's what this Fed will be focused on too, Tom. President Mester talked about it earlier this week. We're looking for that to come in at 0.5. And 0.5 is still pretty hot, Tom.
Well, into your weekend reading, John, it's real simple. This was the theme of Monday, Tuesday this week. I think a lot of pros are really taken back by that monthly, that narrow view of the Dallas Trim Mean Report. I mean, a lot of people were talking about that in the game. It's tangential to what people care about, but it's something that matters. John, it's sort of like how I feel about Conor Gallagher with that 1 year to Crystal Palace and now back with Chelsea.
Oh, there you go.
I mean, I don't think Crystal Palace can do it without Conor Gallagher. That's all there is to it.
You're fired up for the game later.
I'm fired up for the game later. And what's really important, and John, we may be in London for the Crystal Palace Richmond derby. I mean, I'm really looking forward
I'm not sure
to that.
I'm not sure that's how that particular game works.
Season 2, Ted Lasso.
Confused with Ted Lasso again?
No, Season 2 says Richmond's playing Crystal Palace.
I'm sure that, Tom, that's fictional. It's not real. When's Season 3 happening?
What do you mean it's fictional?
Ted Lasso's not real, Tom. I hate to break it to you. It's not real. Season 3's coming out, though. I'm sure they're going to write a nice story for you.
It's fictional?
It's fictional, Tom.
I didn't.
I know, it's a painful moment for you as you work this out. Futures, Lisa. Lisa's dying. Futures unchanged on the S&P. On the NASDAQ, we're down 0.2%. Just let him keep digging.
Well, can I just say one thing? And I know that you didn't get truly angry, but it's frustrating to you, John. I know that it is when people say, is good news, bad news, good news. But that actually is going to be pivotal to see the market reaction to the market to the labor market report. I think that's interesting.
This is something else, John, this week that Lisa brings up. The returns of managers right now. I mean, I'm sorry, there's some brutality out there. There's some good news, bad news. What do we do? Let's take a bet. And there's some shellacking going on.
Look, I know people say all you want to talk about is the Fed. All we talk about is the Fed because a lot of the time all that matters is the Fed. And I long for the days when that's not the case.
Amen.
And we can just talk about the data and good news is good news and bad news is bad news because to everyone else, bad news is just bad news.
Yes, it's certainly on Main Street.
And you tune into these kind of conversations and they just sound, Tom, they sound alien-like. And that's because of the involvement of central banks in markets over the last 15 years.
John, I thought the Richmond Man City game was just outstanding. Jamie.
Honestly, going to keep this up?
No, I just think, don't give me this fictional stuff. That was a hell of a game.
You think it's real? Yeah. I'm sure you do. Futures unchanged on the S&P.
Jamie
Payrolls.
Tart actually reminds me of you.
1 hour and 50 minutes. That's really rude. Payrolls 1 hour and 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. China is lashing out at the US for House Speaker Nancy Pelosi's trip to Taiwan this week. Today, Beijing announced it is imposing unspecified sanctions on Pelosi and her family. China is also halting meetings with American military leaders and cooperation with the US on drugs, climate, and a number of other issues. US health officials have declared monkeypox a public health emergency. That's a step that will free up funding, treatments, and other services to fight the virus. The US leads the world with known cases, more than 6,000 of them. For the fourth month in a row, global food prices have dropped. The United Nations Index of World Food Costs fell more than 8.6% in July. The index is now at its lowest point since January, before Russia invaded Ukraine, a major food exporter. Still, prices remain elevated. People on low incomes are feeling the pinch as the cost of living crisis deepens. South Korea has become the 7th nation to send spacecraft to the moon. The country launched its first home-developed lunar orbiter. It lifted off from Florida's Cape Canaveral on top of a SpaceX Falcon 9 rocket. The orbiter will travel for 4.5 months before entering lunar orbit to begin its mission in December. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
A $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
scared are still, oh, we can avoid recession. We think we won't actually hit recession, a slowdown, but no recession. Come on, we're going to go into recession. Major economies are going to go into recession. It's not going to be a deep recession in the same way as the financial crisis, but it's going to be prolonged.
We need to do a roundtable. That was Lee Farage of State Street Global Markets, and put him alongside Dominic Constant of Mizuho, because Dom is not taking that path at all. He thinks we can engineer a soft landing, Tom. That is the debate right now. Tom Keene, Lisa Abramowitz and Jonathan Ferro going into payrolls. The data about an hour away, an hour and 30 minutes or something like that. Futures right now on the S&P unchanged, on the S&P, on the NASDAQ negative by not even 0.2%. No real drama here. Pretty muted price action, Tom. Yields up about a basis point. Your 10-year 270.
Randall Crosner to join us later as we dive into Jobs Day. We'll do that in less than 2 hours. And what we're doing here is what surveillance is about, to bring to you on radio and television the debates that are out there. And they are heated now on the path of the American labor economy. We heard from Dominic Constant. Anna Wong joins us now, Bloomberg chief U.S. economist. And maybe more than anyone I know, Anna Wong is moving the other way. Anna, we can wax philosophical about the theory of the Phillips curve, the beverage curve, the shift in the beverage curve, etc. You say this is a Chairman Powell who is not very curvy, and he will just raise rates to bring inflation down. How can he ignore theory?
Well, I think the theory, that's the thing. Theory is very clean. The theory will tell you that as if you want to bring vacancy rate down, you need to increase unemployment. But it is empirics that ultimately settle the matter of how much unemployment rate has to rise as you bring down the vacancy rate. And right now, the debate is exactly on how curvy is that curve. And I tend to side with the Summers camp in thinking that based on what we have seen since 1950s, I think the hope for little increase in unemployment as we bring down vacancy rate, that's wishful thinking.
I look at the wishful thinking now, and what it says to me, Anna Wong, is this is simply a Fed inflation-centric. Do they care about this morning's jobs report?
Well, one report wouldn't make a whole lot of difference, but one report does help them feel like are they making progress. So if unemployment rate stays low at 3.6%, and we did see vacancy rate coming down in the June JOLTS report, that means that maybe the Fed's is taking some solace in the chance of getting a soft landing. But I would just say that not so fast yet. Typically, the vacancy rate can come down and unemployment rate will lag by a little bit. I would be paying more attention in today's report on the labor participation rate, and I think the Fed will as well, because at the end of the day, what you want and what the Fed wants is for wage growth to cool. In order to get wage growth to cool, you need more labor supply or you get less labor demand. And in the last 3 months, we have not been seeing good news on the labor participation front. And this means that the Fed will have to do more on dampening the demand side, and that wouldn't be good for rates outlook.
Anna, what is a soft landing?
Well, the Fed's definition is if the unemployment rate rises by about 1 percentage point. So if we get to, if it's less than 5, slightly higher than 4, that would be the Fed's definition of soft landing.
The reason why I ask is because I wonder how much daylight there really is between some of the arguments for people calling for a soft landing, like Dominic Constant, versus though calling for a greater likelihood of a hard landing. How much is this just a distinction of the contours of a recession that is somewhat inevitable just in terms of year-over-year comparisons?
Yeah, I think, economists, analysts, we argue about soft landing, hard landing. At the end of the day, the people in the Main Street will feel equally painful, whether, in a soft landing scenario, just 1% increase in 1.5% increase in unemployment rate, it will be, a lot of people millions will be losing jobs.
Anna, I've got a difficult question on a difficult Friday. Is the path of a lower inflation rate a relatively smooth and gradual path, removed from shocks, or does it have some real kinks to it? Does it have stopping points along the way?
I think, Tom, that's a rhetorical question. I think basically, I think what you're, implying is, yes, it's a stopping point. There's plenty of stopping points. It's not smooth at all. I mean, I think what likely will happen is that the transitory components of inflation indeed will decelerate very quickly going into next year, and we might see headline inflation going down very sharply. But then there's also the sticky part that will persist to be sticky, such as core services, the parts that's driven by elevated wage inflation. The Fed might be seduced to pause rate hikes later next year because the transit component will drive overall inflation down closer to 3 or 4. But then if they don't keep rates high, or even if they pause, then inflation come back up, because you still have that really sticky core components that's pushing it up. And we saw what happened to Arthur Burns in 1974. There was a steep recession in 74. I mean, I think history judged them very harshly, because how would you know that prices wouldn't come down in in a recession, right? But
John, I remember Arthur Burns in 74. Nobody watching or listening does. Only I remember Arthur Burns.
Anna Wong of Bloomberg Economics.
Anna Wong, go away.
That was a clinic. Anna, thank you. Tom, you saw it. Lisa and I read about it. Anyway.
Well, you got me going. Come on. The interview of the week, John, was Dissel of Federated Airmails and her gloom about the dismal 70s.
I go back to something that
was
Hamid wrote
stunning
in the last couple of weeks, Tom, the last couple of months, actually. The prospect of a flip-flopping Fed. If they pause too early, do they have to go again?
What are we going to do at 7%, at 6%? Besides, we're going to be employed over these raging debates. I mean, it's going to be great, John. But I just refuse to believe it's one nice, smooth curve down to 2%.
Lisa's raised the same question, though. What are we going to do? We're going to start cutting as soon as we stop hiking? Lisa, is that what people are looking for now?
That's essentially what people are looking for, that once they hit their peak, it'll be the shortest ever time at that peak before they start cutting. That's basically experiencing the potential for some sort of significant downturn, because otherwise, how can the Fed get the conviction that it is not a repeat of the 1970s? You're not going to see that resurgence that's going to cause that flip-flopping that could be perilous to the reputation that's already potentially somewhat compromised.
Alan Ruskin of Deutsche Bank's done some work on that. He thinks they stay up there for longer. Next time Alan comes on, we can talk to him about it. Peter Oppenheimer of Goldman Sachs is going to weigh in on this equity market in a moment. And what a rally it's been. Up almost 20% from the June 16th low on the NASDAQ 100. That is quite a rally. Futures right now, down about 1/10% on the NASDAQ. On the S&P, softer by 1/10%. Also, yields are higher by a single basis point. Let's round that up for you to 270 on a US 10-year. Going into the payrolls data about an hour or so away. Payrolls expected to come in at about 250K. From New York City, this is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The Fed is hiking pretty aggressively into an economy that's very clearly slowing down.
We're going through a period where the economy appears to be weakening further.
What I worry is on the other side, that the Fed works too fast and too much.
They essentially must hike and must tighten policy if they don't see inflation coming down to 2%.
Come on. We're going to go into recession. Major economies are going to go into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I love Lee Ferriger State Street. He's just like, behave yourself. You know where this is going. From New York City this morning, good morning for our audience worldwide. This is Payrolls Friday alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures unchanged on the S&P. TK, the data, 90 minutes away.
We're going to see the data in 90 minutes, John. It's going to be interesting to go beneath the headline data, maybe more than ever. You got to go right to wages. That seems to be where the debate is. That seems to be where the dynamic is this morning. And I like your idea, John, on monthly inflation data. Maybe monthly wage data matters as well.
What's more important for this Fed, Tom? Today's jobs report, next week's CPI report?
Inflation report. In my opinion, no question, next week's August 10th report is important, but there'll be dynamics within this report that will allude to that.
Elisa, looking for headline inflation next week to come down, core to remain hot.
At what point does the market respond to this in a negative way?
How
much? No, I'm serious, because we've been talking about the signs of recession and the gloom and the doom, and the Lee Ferriges of the world have been very vocal about their opinion, and we really haven't seen it in markets. We've seen an incredible rally. We've seen a loosening in financial conditions at the same time that we're going to get a CPI print that's going to still be very hot. If it comes down to 8.8%, that's still 8.8%, which is a pretty hefty inflation rate year over year.
Nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. That was the Fed in the first line of the statement, the first paragraph of the statement, Lisa, just last week. That jobs report is going to become very important for them if it starts to decelerate. I would imagine a lot of people become even more confused as to what the Fed's about to do.
Which is the reason why perhaps the labor market report may be less interesting than the market's reaction to it. Where is the balance of risk in markets? Is it to a labor market that's continuing to be robust and strong, or is it the opposite, hinging a bet on a weakening in the labor market that we saw in the rise in jobless claims at a time when the Fed needs that to back away from rate hikes?
Lisa, I love it when we're on the same page. It's always about how the market responds to the data. That's where the information is. Where's the information here? The S&P 500 consumer discretionary, I keep going back to this, is up 25% from the June lows. Lisa, what business does consumer discretionary have? Up 25% from the June lows on a month where we've all been talking about recession in America.
The one argument that I've heard about this that makes a lot of sense is it depends which consumer discretionary. If you're talking about companies that cater to the wealthiest Americans, those are going to still be doing okay considering the stockpiles of cash that those individuals still have, at least if you look at averages. On the other hand, if you're looking at, for example, the beginning of another cycle, perhaps that holds a little less water right now.
Let's get you some price action this Friday. It's shaping up as follows. Futures unchanged on the S&P, on the Nasdaq 100 down 0.1%. Just a moment, Lisa will bring you the day ahead. The jobs number's just around the corner. Yields up about a basis point on a 10-year, 269.72. Tom, I can't get used to this. 88 on crude. Where did that come from?
Yeah, this is actually very tangible, John. We've really seen this in all sorts of features. I'd also note, besides West Texas Intermediate 88, John, the important Bloomberg Financial Conditions Index really shows an accommodation.
Lisa, as equities have ripped, commodities have been hammered.
Yeah, and this really is potentially a recession call, and yet it's also given some momentum to some of the gains that we've seen because that is a rolling off in headline inflation. For that main number of the day, 8:30 a.m. non-farm payrolls report for the month of July, and Tom is right. It is not just the headline number, which is expected to be around 250,000. Dig beneath the surface. Average hourly wages, how much are they coming down? Do they go to the expected 4.9% gain year over year? And is that enough for the Fed to say, okay, momentum is cooling a little bit? The other side of this that I'm really looking at, as Anna Wong was saying, is the participation rate. It has been declining. This doesn't make a lot of sense for a market where there are a lot of open jobs and people have an easier time getting positions. At what point do we see this continue, plateau? What does this tell us about the state of the jobs market? And today we get a host of Fed speak as well. Richmond Fed President Tom Barkin among them. I want to see what he says about the yield curve. This is sending a very strong signal if you believe in history. This basically is the steepest inversion going back to the year 2000. This usually portends recessions, and this has only been deepening as the Fed has jawboned markets, the short end of the yield curve, higher in terms of yields and leading to longer-term recession expectations. Does he respond to this in any way, or does he hold the course and continue to say they need to do more to fight inflation? At 9:30 a.m., the messaging from this administration will be really interesting to watch. U.S. Secretary of Labor Marty Walsh will be joining John Farrow on Bloomberg Television.
How come he doesn't come on earlier?
Well, I'm actually really curious to see how they shape a message around this. I really want to know, John, but especially because they got to basically say a softening is required in order to get inflation down. But the message always has to be, we want people to be employed. We want people to be paid.
Can I just clarify Tom's snarky comment? Tom, he can't come on earlier. He has to wait an hour for the payrolls report to come out to then talk about the payrolls report. You know the rules.
Yeah, okay.
Okay.
I thank you for reminding me.
Good. Bank of America say take profit on the bear rally. HSBC, they've added to this. They say it's time to ditch stocks. Barclays say the emerging Goldilocks narrative feels misplaced. Every rally is built on wishful thinking. It's just whether that wishful thinking is misplaced or not. Peter Oppenheimer at Goldman joins us right now to try and answer that question. Peter, help me out. The wishful thinking currently, misplaced or not?
Well, I have to say, I think it is. I can understand why stocks have rallied, and as you have quite rightly pointed out, you've seen a significant pullback in interest rates, and the market seems to be more convinced that inflation is close to a peak. And given that rates rising were really the trigger of this bear market to begin with, particularly for long duration stocks, it's provided relief. But if it's indicating that a recession is coming, it seems premature for equities really to have troughed and for this rally to have been the genuine inflection point.
Peter, I want to go to your European constituency. I usually don't do this because we're so American-centric at 7:06 a.m. in New York, but this really matters. Peter, the theme is quality and buy America. Should Europe institutional buy side load the boat on America and load the boat on quality shares in America?
Well, I think to a large extent that's already what's been happening for a long time. The US has hugely outperformed Europe, and much of that was justified by much stronger economic growth in the US and by US profits outpacing those in Europe significantly, partly because it had a lot of exposure to technology stocks, which Europe did not have. The weaker euro has also added another incentive for European investors to get access to US assets. And so we have seen, I think, quite a lot of flows coming out of Europe into the US. And given the obvious concerns at the moment in Europe, as well as in other areas, but in Europe specifically around gas supplies, that's probably going to continue. One thing I would say, though, is that Europe also has its fair share of quality, strong balance sheets, stable companies, and they have been outperforming in the European market quite strongly.
Well, Peter, given the fact that you do see a much more dire picture in general overall for Europe than the U.S., I was looking underneath at your GDP calls, and you actually see Europe doing better than expected, better than the consensus, and you see the U.S. economy doing worse than consensus. Do you think it's time to actually buy into the European story because things have been beaten up so much because the consensus has been too bearish, in your view?
Well, I think that we do see a recession in Europe, a relatively modest one, and there are some important supports that are worth emphasizing. You know, Europe's private sector balance sheets are quite strong. Banks finally have strong balance sheets, so do corporates, and how